Introduction. You've probably invested at one point or another. Perhaps then you didn't even know you were investing in something. For example, some people consider a college education to be an investment. This is because when you invest, you are putting in some of your resources with the intention of making some future benefit from it. Education can be said to work that way too. However, the above is a general definition of what investing actually means. In its narrow sense, investing is the process of committing some money to a financial asset or security. The aim of it is that the initial money put in will multiply, yielding dividends for the investor. Warren Buffett, who is arguably one of the greatest investors of all time, provided his own definition of investing. According to him, investing is the process of laying out money now to receive more money in the future. The intention of the investor is to put his funds into one of the investment channels and then watching it grow over time. Investing entails prioritizing how one's money is used. Spending money is a lot easier than saving, and even harder than investing. With spending, there is the immediate gratification that comes with the new outfit or the vacation that the money was used to purchase. Investing, on the other hand, is putting aside the immediate wants for future gains. From investing, we can thus get a definition of an investment. An investment is defined as something of value acquired with money that is expected to grow over time. Investments can be divided into three categories. They are ownership investments, lending investments, and cash equivalents. Ownership investments. These are the investments that people are most familiar with. It is the type of investment that readily comes to mind any time one is asked what an investment is. Furthermore, this class of investment is the most volatile. They carry the greatest risks, and as a result, they also carry the greatest benefits. Ownership investments include stocks. Simply put, a stock grants you the right of ownership over some part of a company. In general, all securities are examples of ownership investments. A purchase of stock gives you certain rights within the company. It also gives you the ability to have a share of the company's profits in the future. Another example is the money put into running a business. Entrepreneurs go through a lot of risks while running their businesses. The task is easily more demanding than a lot of people presume. It is an example of ownership investment that has a lot of potentials. An investor can make a lot of money simply by creating a product. As long as the product solves human needs, it will definitely generate sales. You only need to look at Microsoft founder Bill Gates to realize how powerful a person's product can be. Real estate is also an example of an investment. The houses that you buy and/or the ones you sell after renovation can also be termed investments. Of course, the house one currently resides does not fall under this category. This is because although the property may appreciate over the years, it has just one function still. As long as it continues to provide the use as shelter, it cannot be called an investment. Finally, objects such as paintings, valuable art, and pieces of jewelry that are valuable can also be examples of ownership investments. The important thing to note here is that the objects must be bought with the intention of being resold. If the objects are bought purely for their aesthetic or artistic value, then they can hardly be considered investments. Jewels and such other precious metals may not be good examples of investments. This is because their values depreciate with time. Lending investments. Lending investments put you in the same position as a bank. Generally, they pose fewer risks than ownership investments. As a result of lowered risks, they also offer lower returns for investments. For instance, a bond issued by a particular company can only earn a set dividend. On the other hand, the stock of a company may double or even triple its value within the same period. Also, the stock may lose heavily within the same time frame. As you must have already figured out, an example of lending investment is a bond. A bond is a general term used to refer to a variety of securities. They include treasuries, debt issues, and credit default swaps, CDS. The profits that come with each bond vary depending on the nature of the bond. Some of them, by their very nature, have high risks attached to them, almost as high as a stock's. However, the basic rule is that lending investments have lower risks and lower returns than can be said of ownership investments. Cash equivalents. These investments are easily convertible from securities to cash. They are said to be as good as cash. The most popular amongst them is money market funds. Money market funds yield very small returns on the investment. The returns usually fall within the range of 1 to 2%. Consequently, the risks are also very minimal. There have been some instances where money markets yielded very high returns. However, those times have not been constant and cannot be used as a template for how money markets work. There are several purchases individuals make which they consider investments but sadly are not. An example of this is consumer purchases. Whatever the consumer purchases, whether they are edible or not, are certainly not investments. Every item that depreciates over time cannot be considered an investment. There can hardly be anyone willing to purchase second-hand consumer goods at the same initial price of purchase. Even celebrities, who sometimes auction off their household items, do not recover their purchase price. A lot of people tell themselves that they are investing when buying consumer goods to lessen the guilt of impulse buying. Differences between investments and savings. A lot of individuals tend to mix up the concepts of savings and investments. However, they are not the same. They play different roles in the lives of individuals either saving or investing. Furthermore, savings and investments achieve different purposes. Saving money or valuables is the process of setting aside resources for later use. They are usually put in very safe and liquid accounts. An account is liquid if it can be accessed within the shortest possible period. For instance, in the case of cash savings, you should have the ability to save and retrieve the money with minimal stress. Savings are usually for shorter periods than investments. The goals sought to be achieved are not so distant in the future. This could include plans such as going on a vacation in a year, going shopping at a later date, etc. Typically, savings towards a particular project should not take up to 3 years. There is minimal risk with savings. This is especially true when your money is deposited with a financial organization that insures your cash to a reasonable extent. In the United States, individuals who save their money with the Federal Deposit Insurance Corporation have their money insured. They are entitled to $250,000 in the event that unforeseen circumstances occur. Finally, some interest may accrue due to savings. If money is deposited in a savings account and left for a significant amount of time, it may generate interest. The interest, however, cannot be compared with what is obtainable with investments. Contrary to savings, investing involves the use of money to purchase assets the investor thinks will yield profits at a later date. The investor works with the mindset that the investment will yield favorable turnover after the passage of a particular time. Although there are no certainties with investments, there are often margins of expectations the investor considers before investing. Investments are usually the opposite of savings. They are for longer periods of time and are used for the attainment of a major goal. With an investment, it may be difficult to have access to the cash on short notice. Furthermore, there is always the danger of loss with investments. The risks associated with investments are higher than the risks associated with savings. This means that there are higher chances of losing a lot of money than with savings. Conversely, investors have the possibility of amassing interests. When the value of an investor's investment goes up, it automatically means that his net worth will increase as well. If at that point the investor decides to sell, he will make higher returns than he invested in at the beginning. From all these examples, it is clear that what informs your decision on whether you save or invest is the end goal you have in mind. Also, your risk tolerance level also plays a part. It determines if you can stomach the pressures that come with investments. One thing is certain, however, there is a promise of higher rewards in investments than with savings. Benefits of investing. Investing is a skill that is almost as old as time itself. It is one of the most assured ways of creating wealth. This tool is employed by both the wealthy and even the individuals who do not have so much money. The most prevailing thought in the mind of an investor is seeking a means of turning his wealth to create more wealth. For the individuals who are not wealthy, there are several systems that make it possible to start with a small amount. From there, the investment can grow over time. A lot of individuals compare investing to gambling. There are some similarities in that both require a measure of speculation. In investing, however, the investor has to exercise a great deal of patience. Investing involves commitment over a long time frame. In this regard, it is different from trading, which is usually for shorter periods. The length of time investing takes also ensures that there are reduced risks associated with the investing process. The returns that accrue due to an investment could be in a financial form. It could also be in the form of an increase in the value of assets. The paramount question in the heart of anyone reading this should be, why should I invest? And that in itself is a valid question. This is because before you embark on any venture, you should be aware of what is in it for you. The benefits of investing are numerous. For ease of comprehension, I will try to list and explain them simultaneously. It leads to the creation of wealth. This is a no-brainer. If you intend to accumulate wealth, you need to start investing. When you refuse to invest, your money does not grow. Furthermore, it does not yield any returns in the long run. Most securities offer returns when invested in over a relatively long period of time. This is the most efficient way of making use of the money earned over time. This is because you will be making returns on already earned money. Investing is a sure way of beating inflation. No matter the amount of money you keep in cash today, the worth won't be the same in a year's time. According to research, you will lose 4.5% of the money you keep in cash. Truth is, inflation is an economic reality that has come to stay. Putting your money into investments helps stem the rate of inflation. The gains from the investments will keep your purchasing power constant. Investing is an excellent way to create retirement funds. Investments are usually made when one is earning some money. The returns from the investments can prove useful when you finally retire from active work. At that stage, you may be too old to work. Setting aside some money to be put into investments can be an insurance policy. Of course, you could decide to go through an actual insurance system. Reduces your tax payments. Some securities have the benefit of providing returns while saving you taxes. This, in turn, also reduces the liability you have from taxes, such as the Equity-Linked Savings Scheme ELSS fund. When money is saved through this means, it can then be reinvested to make more money. Investing yields high returns. Unlike saving with a bank, investing yields higher dividends. Saving with a bank just gives you an average return of 4%, but an investment yields much more. Steps to start investing. Now that you have a grasp of what investing is, the next stage is talking about the steps you will have to go through to become an investor. This is only a peripheral discussion on the steps a beginner will take. An in-depth discussion of the stages involved in investing will be considered later. Under this heading, there are 3 stages available for a beginning investor. They are make money. No doubt this is the simplest rule to follow. This is because it is only when there is some money available that some can be invested. A lot of individuals have been misled into thinking that saving money over a long time eventually yields compounded interest. That is true, but what is equally true is that one can only do so much with so little. If the amount of money you have is negligible, there is certainly a cap to the revenue it can yield you. For the beginner, the funds to be invested usually come from their income. The income that may be invested are of two broad types: passive and active. Active income comes from one's work, usually some sort of steady employment. Passive income, on the other hand, is the returns from the investments made by the individual. If you are thinking of beginning investments, it is safe to assume that it is your passive income you want to grow. Or maybe you want to begin creating your passive income in the first place. However, your passive income will only grow from your active income. Thus, if your active income is low, you may need to look into ways to increase it, some of which may include changing career paths. Alternatively, you can seek to gain further qualifications to upgrade the amount of pay you receive from your current employment. Save enough of your money to invest. Some persons make a considerable amount of money, yet find it hard to invest. The only explanation for this is unwise spending. Taking care of this problem is not as easy as spending the money. This is because, for a lot of individuals, the push to spend is greater than the push to save. To stem unbridled spending, the individual needs to develop and stick to a stringent budget plan. You need to begin by first taking a look at how you spend your money each month. Categorize and itemize each item you spent money on. Then decide if that item is a need or a want. Effectively, you will be deciding if that item is an absolute necessity or whether you can live without it. A lot of the time, the bulk of the spending we do are on things we can easily live without. And what is most tragic about it is that we often do not realize when we are overspending. Setting up a budget and sticking to it will help you recognize the items you don't need. This will then help you plan accordingly and save some money in the long run. One of the ways to cut your spending is through the kinds of cars you drive. Inheriting a car might not be as glamorous as buying a new one, but it may be the wiser thing to do. Car loans come with ridiculous interests. The intending buyer often fails to see this while blinded by the thrill of the purchase. Invest. You will be surprised at the number of people who want to invest but never get to. For these individuals, investing is little more than wishful thinking, and no matter how much energy you put into wanting to invest, you will never realize the income you dream of. Another group of individuals is those who actually invest but make investments the wrong way. The first rule of hitting it big is realizing that you cannot always play safe. If you cannot take the risk of putting your money in a few risky ventures, then you may not be ready to invest yet. Of course, an understanding of the various types of securities will aid you in your path to investing. You may also need to consult a financial advisor at some point or hire a manager. The intricacies of those will be discussed subsequently. However, you need to be guided by these principles of investing first. If you can focus your attention on these, you'll be ready to invest. Chapter 1. Types of Investors. Angel Investors. An angel investor is a wealthy individual who provides financial backing for startups and entrepreneurs. These types of investors are usually found within the individual's family and friends. That is because the investor usually knows the individual and thus will believe in his plans. The angel investor may provide funds just once to start up the investment. Alternatively, the investor may also provide some funds to help the individual through the shaky start. Angel investors typically invest in a startup investment idea at the beginning stages. Angel investors take a lot of risks while investing in startups which have not formed a basis yet. For this reason, angel investors do not put so much of their finances in this sort of investment. The investments hardly exceed 10% of their entire portfolio. The terms stipulated by the angel investor are usually more favorable than mainstream borrowing. The angel investor is more interested in helping the entrepreneur start up his business. The viability and the subsequent profits to be made from the business do not matter as much as helping the entrepreneur. Therefore, in this regard, angel investors differ from venture capitalists. Also, unlike venture capitalists, angel investors do not demand aggressive growth. They are usually drawn by the passion and commitment of the founder. In a sense, the angel investor is more drawn to the brilliance of the startup idea than the returns. Angel investors usually invest in exchange for ownership and equity. Typically, they invest anywhere from $25,000 to $500,000. Sometimes, angel investors also go through crowdfunding to find entrepreneurs to invest with. There are also angel investor networks where they come together to pool resources to fund businesses. A lot of entrepreneurs prefer angel investors because it is less predatory than other forms of raising funds. They are usually the last resorts for entrepreneurs who may not have access to bank loans. Angel investors originated from Broadway. The term was used to refer to wealthy patrons who step in to save a production at the brink of failure. Before there were angel investors, patrons were the ones who played the role of angel investors. They usually offered financial assistance to struggling artists seeking to make a mark with their artistry. The term was first used by William Wetzel while conducting a study on how entrepreneurs garner funds. Wetzel is the founder of the Center for Venture Research. His description seems apt for the kind of investing they do. Venture capitalists. Venture capitalists make investments in companies by acquiring some of the shares referred to as equity capital. The idea is that the equity capital value will increase, granting them profits. Venture capitalists are more inclined to work with established companies. These companies must have realized some profits already. One thing that must be borne in mind is that venture capitalists take up a share of the business. In some cases, a venture capitalist will want to also make management decisions. The entrepreneur needs to be aware that the return on investment, ROI, to be paid will be higher than traditional borrowing. It may be advisable to draft a partnership agreement before working with a venture capitalist. The agreement should spell out exactly what the duties and expectation of each party are. It will also be important to have a mutual acquaintance introduce you to a venture capitalist. That way, you will have a person to refer to in the event that a disagreement arises. Value investors. Value investors are mostly concerned with ascertaining the intrinsic worth of any stock. Once they have successfully determined what the intrinsic worth of the stock is, they go ahead and invest. A value investor will invest if the price of the stock is lower than its intrinsic worth. The investor believes there are several factors which could affect the price a stock is set to. The value investor believes that the market will eventually realize the true worth of the stock. Therefore, when the stock price eventually catches up with the intrinsic worth, the investor will make profit. A detailed description of value investors will be discussed subsequently. How to locate the right investor. Now that you know the various types of investors available, you are ready for the next step. The next step is having you decide how you will get the finances from these investors. Identifying the investors is one thing, Getting them to fund your business is a different ballgame altogether. The first step in this process is deciding whether to make use of either personal savings or personal borrowing. If you intend to make use of personal savings, then you do not need investors. Making use of your own personal funds, as opposed to getting help from investors, has its own benefits. First of all, it gives you the freedom to explore the full extent of your ideas without being tethered to the investor. Also, the money is already at hand, so you do not need to go through the rigors of sourcing for funds. Because of these benefits, it is fitting that personal savings as a source of funding for investments be discussed before other options are explored. Personal savings are of two broad categories generally. They are cash equivalent savings and retirement accounts. Apart from the few listed benefits of personal funding above, it has its drawbacks too. The investor's personal funds may be insufficient to totally fund the investment. Also, some individuals may not be inclined to gamble with funds that will be needed for other purposes like college education or retirement. An individual may not trust the investment process enough to be able to commit such funds to it. Another alternative to the use of personal savings is through personal borrowing. Personal borrowing is usually easy for investors who have high credit scores. It will also be an added bonus if the investor has a high net worth. Personal borrowing usually involves taking out a loan in your personal name. It may also involve getting a new credit card and extending your line of credit. Borrowing has the risk of sinking you further into debt. It could also lower your credit score, making it potentially difficult for you to obtain loans in the future. As stated earlier, the first level of financing is personal funding of the investment process. The investor is expected to first explore this option and decide its suitability for his investment pattern. If for any reason he finds it impossible to fund his investment idea with his personal funds, then he could explore the options explained below. Determine exactly what you want from the investor. Choosing an investor involves more than simply asking people for money. It entails asking for a level of commitment from the potential investor. Therefore, you should be careful to ensure that this potential investor is someone whose philosophy is one you agree with. It's important that you take a look at a person's investment history. You should be happy with the expectations an investor will have for you after investing in your business. All of these options will help you in deciding which investor you may eventually pitch to. Search in the right places. If you are finding it extremely difficult to gain access to an investor, chances are that you are going about it the wrong way. There are databases that could help you search. Some of these include AngelList, Angel Den, and the likes. Create the right network. Investors usually gauge a person's worth before making an investment. In some cases, the investor may seek information from the people within your circle. It will also help if you have a stellar reputation within your community. A good word put in for you by someone in your circle might make all the difference. Once you have selected a particular investor, begin cultivating people with whom you have mutual relations with the potential investor. Settle for a person who will initiate the connection between the investor and yourself. Make sure that this person knows you and believes in your pedigree. Do not ever think it is impossible to get from where you are to an investor. It has been said that one is only 3 people away from whatever individual he wants to make a connection with. That is true. You can test it just to be doubly sure. Develop an amazing pitch. The next logical step after meeting your investor is to make a pitch to him. In most scenarios, this could be your only chance to make a good impression. Simply put, nothing beats preparation. Identify your unique selling point and build from there. Why does investing matter to you? What do you intend to achieve with the money realized from your investments? What sets you apart from any other investor? The investor will like to know what your chances for success are. If the individual is a seasoned investor, then he will definitely not be new to taking risks. However, every investor, whether seasoned or not, will like to know how you intend to minimize losses. You should have the answers to these questions before you even begin making your pitch. Be sure you can handle every possible foreseeable scenario. Move on quickly from rejections. Chances are that the first few investors you approach may turn you down. You must be prepared for this. You should never let failure weigh you down so much you are unable to move forward. One of the ways you can prepare ahead of time is to make a list of potential investors. It's important you also complete extensive research on them. You should also consider their past investments and how good or bad they turned out. You should compile a list of about 20 people even before you start approaching them individually. The idea is that if one of them does not work out, you move on to the next. Carefully work your way through those names until you have exhausted every option. You can be rest assured that before you get to the end of your list, there will be someone willing to fund your idea. Chapter 2. Introduction to Value Investing. Value investing is a style of investing where stocks are selected on the assumption that they are trading less than their worth. They could either be intrinsic or book value. Value investing is actually pretty simple. It does not require extensive knowledge of the financial market, stocks, or the likes. What is required is an armload of patience, a willingness to learn, and some money. Investors who follow this philosophy of investing routinely seek out stocks undervalued in the market. They work with the assumption that the market may be rash in reacting to events within the stock market. The effect of this is the undervaluation of a stock. Value investors also believe that the current estimation of stocks may not reflect the long-term vision of a company. Therefore, stocks become undervalued because of the irrationality of the market. Value investors try to make money during this period by buying such stocks and hoping their worth will increase. Typically, value investors make investments in companies with below-average book-to-price ratios. They also look for companies with higher-than-average yields. The investor will only invest after a careful review of the stocks. However, when it comes down to it, estimating the worth of stocks may not be entirely easy. There isn't any science that prescribes exactly how an investor should value any stock. It makes it appear as though value investing is more of an art than a science. Because of the subjective nature of the estimation of the value of stocks, investors will sometimes create guiding rules. One of these rules is deciding what their own margin of safety is. Investors give themselves room to make some errors in their estimation and set aside funds to rectify the errors. The subject of margin of safety will be discussed later. Different investors have different rules they follow in arriving at the intrinsic worth of stocks. For some, the emphasis is placed on existing finances, so they do not consider future growth. While for others, more attention is placed on the estimated growth potentials of the company. However, regardless of the approach employed by different investors, the end result remains the same. That is, the purchase of shares valued lower than their worth, which are held over a long period to make future gains. Undervalued stocks are usually discovered by going through a company's finances. This is the method employed by Warren Buffett and Peter Lynch, who are famous for their wealth from value investing. Through this process, they identify undervalued stocks, invest in them, and wait for a turnaround. History of value investing. Authors Benjamin Graham and David Dodd are credited with being the inventors of the term value investing. They developed the concept while working as finance professors at the University of Columbia. At this present moment, they are hailed the pioneers in their field. Their book, Security Analysis, is the foremost text on the subject. By the early 1920s, investors relied heavily on speculation while making trades. There was no general method of determining the worth of a stock so as to enable investment. Benjamin Graham, however, believed that a method could be evolved to determine the worth of stocks. Within this period, he worked with Dodd to come up with the concept of value investing. He sought, by the concept, to develop a method which will determine the value of stocks, thereby aiding investors. Graham and Dodd's concept evolved the first rules for rational investment decisions. In 1928, Graham began teaching this concept at the University of Columbia. Over the years, he revised the bulk of the work, but the general principles remain the same. The course was so remarkable that it was taught to both students and Wall Street professionals. After Graham retired, Roger Murray took over the teaching of the course. The course was temporarily suspended for a brief period after Murray retired in 1978. But by that time, there were several graduates who were vigorously applying the principles of value investing. Some of them included Warren Buffett, who graduated in 1951, Mario Gabelli, and Charles Royce. Over the years, value investing has proven to be one of the most consistent ways of making profits for investors. This is so even with the uncertain nature of the economy in recent years. The successes of these investors has lent some measure of credence to this particular investment approach. Furthermore, they have also established value investing as the most effective modern-day economic theory. This is particularly remarkable considering that the concept was fine-tuned around the 1960s. In the early 90s, the investment management curriculum was reintroduced at the Columbia Business School. Around this period, Mario Gabelli persuaded Roger Murray to give a series of lectures on value investing. The lectures were highly successful, which led to value investing being reintroduced into the institution's calendar. There was also the establishment of Robert Hilbrun School of Finance and Asset Management. Its executive education arm commenced a course on value investing. It grew to become so big that it was also oversubscribed each time. The institution also began its annual Dodd and Graham Breakfast. The event is held each year during the fall season. It is the gathering of the crème de la crème of the investing world. In 2001, a permanent home was created for value investing at the Columbia Business School. This was through the founding of the Heilbron Center for Graham and Dodd Investing. The significance of this cannot be overlooked. The birthplace of value investing has become a grooming ground for generations of investors. Advantages of value investing. Value investing is based on a simple philosophy. A lot of people do not recognize good stock when they see one. That is the reason value investors seldom invest in businesses that are doing well. They do this with the understanding that if the business is doing well, a lot of people will be buying the stocks. On the other hand, if the prospects of a business aren't visible on the surface, a lot of people won't purchase the stocks. Essentially, driving the price down and making it cheaper to buy allows for great investments. By buying shares that are undervalued, the investor gains more. One constant is the fact that the market is unpredictable and may turn up for the better. In the event that they turn up for the better, the investor gains the difference between the intrinsic value of the company and the initial purchase price. Also, value investors realize that when stocks sell low, it is for a particular reason. Perhaps the company is going through a period of turbulent times. However, this might not always be the case. The value investor goes through a lot of trouble to ensure that not only is the stock undervalued, but also that it has potentials of appreciating. Some of the other advantages of value investing are: Value investing is open to everyone. Whatever your educational qualifications are or your financial background, you can be a value investor. The minimum requirement is interest and enthusiasm regarding investments. Apart from that, the next requirement is patience. The value investor should be a patient person, and this patience informs the bulk of the decisions he or she takes. Apart from these two requirements, patience and an eagerness to learn, there aren't any other requirements for becoming a value investor. Value investing is the easiest way to make use of compounding. Value investing is an excellent example of how compounding works and its power. For example, when a person makes some money from value stocks and invests it back into the business, there is exponential growth. This is a pattern that is followed by most value investors. The way value investing works is you get to make profits from your investments easily. The returns on your investments grow without requiring a lot of effort on your part. Value investing is the smartest way to benefit from the stock market. Value investing offers one of the easiest routes to making money from the stock market. First of all, value investing is not affected by the various short-range market dips. Also, the value investor is not charged the many fees individuals who trade within such short ranges are. As stated earlier, value investors look beyond the underlying emotions in the stock market. They make their decisions based on actual data. Through this, they are able to come up with new strategies for their clients. Less risk. There is less risk associated with value investing when compared to other areas of investing. When compared with other forms of financial analysis, including short-range trading, value investing offers comparatively lower risks. Here, the investor is not caught up in the random price fluctuations experienced in other short-term investing. The fact that the stock is held for a relatively longer period ensures this. The investor also does not have to constantly monitor the stock every day. One of the greatest contributors to a loss in the stock market is the wrong timing of buying and selling. For the value investor, there isn't the risk of encountering that. When stocks are bought and held over an extended period of time, there is less risk of error. The investor is not pressured to make the decision of either buying or selling in order to perform better than the market. When this sort of pressure is eliminated, the investor thus makes better decisions overall. Value investing offers the opportunity for correcting errors. There is always the possibility of making errors in any type of investing. However, with value investing, there is always the opportunity for a do-over. Here, this possibility is made available because value investors invest within a margin of error. This margin provides room for the investor to correct errors that may arise in the course of investing. This is helpful for the value investor because they are able to make better investment decisions with the knowledge that there is room for correcting errors. The downside of value investing. Although the benefits of value investing are numerous, there are also some downsides to it. They include difficulty in determining the intrinsic worth of stocks. Value investing is hinged on the philosophy that the intrinsic worth of stocks is often misrepresented by companies. The idea is that these unrecognized stocks are often worth more than their market value. However, one issue that arises is the determination of the intrinsic worth of stocks. This is perhaps the biggest challenge for the value investor. Determining the intrinsic worth of any particular stock is a subjective assignment. Different investors arrive at their conclusions using different processes. These processes are often specialized and outside of the scope of the investor. Methods employed by different value investors are usually unique to them. The level of accuracy for each investor cannot be guaranteed. Also, it may be difficult estimating what the actual earnings of a company could be. Usually, valuing a stock involves making decisions based on the information available about a particular company. The investor will be expected to go through the company's history before arriving to a conclusion. There is no standardized method for this, and this may prove difficult for investors. A lot of patience is needed to be successful. To be successful as a value investor, the investor needs to learn to be patient. He has to be able to wait for the stocks to become valuable again in order to make a profit. This may sometimes take months, and in some instances, even years. There isn't an instant gratification to be obtained with value investing. Also, the value investor has to follow a particular pattern, leaving no room for experimenting. This one philosophy will be the guiding light for the investor for any and all investments. This may prove very difficult for investors who want to make some quick bucks. Having to wait for a turnaround can be both unnerving and backbreaking for a lot of individuals. Many others may also lack the patience, not just to wait, but to also stick with a singular pattern of investing, especially in the instances where they experience occasional loss. The advice generally is that if you cannot be patient, you have no business being a value investor. Fundamentals of value investing. Finally, to wrap up this section on value investing, we need to discuss its fundamentals. These are the basics that anyone who wants to go into value investing should follow. They are the guiding principles, the very foundations that the principles of value investing are based on. They are: companies have intrinsic value. This forms the basis for value investing. The supposition here is that every company has an intrinsic value which may often not be realized. This is important because once the intrinsic value of any company is recognized, purchases can be made at the right time. A company's intrinsic value remains relatively constant. The prices of the stocks may change, however. The value investor works with this philosophy, investing in companies even when their stock prices fall. The efficient market hypothesis is often inaccurate. The efficient market hypothesis postulates that a stock's price is a true reflection of their value. It suggests that each stock takes into account all the information regarding the company. Value investors believe the efficient market hypothesis is inaccurate. They believe, rather, that a number of factors could influence the price of stocks. For instance, a stock's price may fall because of apprehension or panic in the global markets. An example of this is a sheer drop in stock prices during the Great Depression. Conversely, prices of stocks could go up because of excitement too. In these two instances, the price of the stock was influenced by external factors, unlike the efficient market hypothesis. This is in tune with the belief of someone who subscribes to value investing. That is, other factors could influence the price of stocks. Value investors are contrarians. Value investors do not follow the herd. They want to go in the opposite direction of everyone else in the investment market. For starters, they do not agree with the efficient market hypothesis. Also, when others are in the buying frenzy security-wise, they will usually be selling their stocks. And in the times where people are selling, they'll either be buying or will stand back and not do anything. Typically, value investors do not buy stocks which are popular in the market. This is mostly because popular stocks are usually overpriced and expensive. They will rather seek out stocks that are undervalued but show signs of promise. Value investors regard stocks as tiny parts of the company. They believe that in owning a percentage of a company's stock, they own a percentage of the company. They look beyond the momentary financial gains and instead focus on the bigger picture of owning stakes in companies that will yield them returns in the future. Unlike other investors who leave companies as soon as they show signs of distress, value investors are loyal. They look at the finances of a company, and as long as the prospects are good, they stick with it. Every investor should take advantage of the margin of safety. Margin of safety refers to the gap between a stock's real, intrinsic worth and its current market value. Investors often set what their own margin of safety is. So, when engaging in value investing, they are mindful of this fact, and it helps reduce the risks they take with relation to investing. In our everyday life, we sometimes apply the principle of the margin of safety without realizing it. For example, imagine you buy a pair of shoes for $15 less than the full price. You may be doing this because you realize the shoe may eventually turn out not to be a good fit. If the shoe eventually turns out to be a terrible purchase, you'd lose $15. Compare this loss to the original purchase price. Without the discount, then it doesn't seem like you have lost a lot of money. If, on the other hand, the shoe lasts for longer than you anticipated, you will gain something out of it. The point here is that when you create a margin of safety, you win either way. The father of value investing, Benjamin Graham, made popular the concept of margin of safety as well. Investors decide on the margin of safety for every security they engage with. This painstaking process includes taking into account qualitative and quantitative factors about security. These include the reputation of the company within the market, assets and management, and governance. When all of these are taken into consideration, a conclusion is then reached on the margin of safety of that particular security. Warren Buffett has declared several times that the margin of safety forms the cornerstone of his investing. He dedicates as much as 50% of the intrinsic value of a stock as his margin of safety. It must be pointed out here that the margin of safety does not remove entirely the risks associated with investing. The risks will always be there in any sort of investment. What the margin of safety does is reduce the risks to the barest minimum. It also ensures that the investor does not run into losses when seeking to sell the stocks. This is because when stocks are purchased at a bargain value, there is an optimization of profit and it minimizes loss. Value investing distinguished from speculating. An investment can simply be defined to be any sort of asset acquired with the aim of it appreciating in the future. Speculation is any venture entered without any concrete expectations of returns. It involves really high-risk moves with the promise of big returns, too. People often make the mistake of tagging anyone who buys any stock to be an investor. That is largely inaccurate. It is possible that a person purchasing a stock is not doing the same as an investor, but merely as a speculator. Investing is not quite the same thing as speculating. There appears to be similarities between speculating and value investing. Perhaps this comparison arises from the fact that every form of investing involves some form of speculation. Every investor who invests in any security does so on the basis that he expects to generate returns. Of course, for others, they can determine with some level of certainty which direction their investments will turn out. For the value investor especially, the track record of the company grants some assurance about the stock's viability. This cannot be said for other forms of investing. In this regard, value investing and speculating may appear similar. There are also differences between the two concepts. The value investor needs to understand these differences before beginning to invest in the first place. It will help the investor identify his risk tolerance, which is a key component of investing. The main consideration is in the amount of risks undertaken under the two terms. In speculating, the risks are higher. In some ways, you can compare it to gambling, whereas value investing takes into consideration the company's fundamentals and the prospects of the security before investments are made. An example of an asset of a speculative nature is cryptocurrencies. Cryptocurrencies are famous for their high volatility. In late 2017, cryptocurrencies such as Bitcoin surged in their value. There was the subsequent rush for purchase by investors. A lot of those investors made huge returns from trading the currencies, while a lot of others lucked out. However, cryptocurrencies, by their nature, are speculative investments. They have a short lifespan in the stock market. In simple terms, if you buy something with minimal risk, you are investing. However, when the purchase is high risk, you are speculating. The two terms do have a few things in common. The difference is usually the amount of risk the investor is willing to take. Another difference between value investing and speculating is the amount of time spent in the stock market. Speculators do not spend a lot of time with any stock or security. They move quickly, buying and selling securities within a short period in the same way as day traders. In the stock market, day traders aren't considered investors. They make investments in the short term, relying on a phenomenon known as a random walk. A random walk is defined as no set pattern for growth. In this regard, stocks follow the path laid down by the speculator's erratic investment pattern. In the stock market, stocks tend to move up and down with little rhythm. This is the period speculators usually buy stocks, contributing to the already erratic pattern. However, in the long run, they eventually begin to make profits. It is within this period that investors invest and make their returns. Another area of difference is in the reason they purchase stocks. It has already been stated earlier that both investors and speculators purchase stock options. However, a speculator will most likely buy a stock because it is in play. This means that the stock is considered valuable by a wide range of market participants. They do not consider the fundamentals of said company. They also don't conduct careful analysis, but simply hope the stock will rise and they'll make a profit. Because of this, speculators tend to drive up the price of stocks. Value investors work to even out the market because they buy when others are speculating or selling and vice versa. Speculators themselves provide the investing grounds that are loved by value investors. They often purchase stocks off a hunch and need little more than that to sell off the stocks. In this scenario, the prices of the stock eventually get dangerously undervalued when all of the attention has been taken off of it. Differences between value investing and growth investing. As you embark on this road towards investing, you will realize that there is more than one way of making fortunes from stocks. One way of doing this, as discussed earlier, is through value investing. Another way of making money from the stock market is through growth investing. Both investing styles represent fundamental systems through which returns are made in the stock market. The difference between the two styles is not in how they are bought or sold. The difference also does not lie in the quantity of stocks they own in a company. The major difference is in their approach to the idea of investing. The two approaches are diverse, but can be used together and can complement your portfolio as an investor. Growth investors are usually drawn to companies with a projected accelerated growth rate. The projections are usually found in empirical evidence based on the surrounding circumstance. However, there is no guarantee that the projections will actually yield the expected returns. This growth is usually in the form of increased revenues and profits. For this reason, growth investors simply reinvest the revenue they generate into the same company. The reinvested revenue is then used to expand the company by hiring new staff, purchasing better equipment, etc. The projected growth rate of the company here is expected to keep increasing above the market average. Growth stocks have a high price-to-earnings ratio when compared with value stocks. Growth investing is usually associated with new or up-and-coming companies. These companies should not have a history of big turnovers behind them. What they usually have is the projections of making great profits eventually. The companies maintain a high turnover even in the face of adverse conditions in the economy. While other companies will be slowing down, the reverse will be the case with them. Growth investing offers investors the promise of richer rewards in the short term. The investor gains the difference between his present investment and the projected future appreciation of the capital. This, of course, also comes with bigger risks for the investor. The reason the investor in growth stocks does not receive dividends is hinged on the reinvestment strategy employed, though the dividend is paid in some cases. However, in most cases, growth stock investors do not receive dividends. Growth investors bet their money on the fact that a company's growth will bring bigger profits and also that these profits will then trickle down to the investors who purchase their stocks. But this is not always the case. Generally, some of the characteristics of growth stocks include high earnings growth records. During periods of upheavals in the stock market, some companies may experience a reduction in their rate of growth. But ultimately, growth companies experience boosts in the value of their stocks. When they gain traction, growth companies manage to bring in benefits regardless of the state of the stock market. Growth stocks are more volatile than others in the broader market. Growth stocks have the potential of dipping in value over a short period. Negative news about the company has the potential of impacting the value of the stock. The volatility of growth stocks is very high. There is always the fear of incurring losses in growth investing. This is primarily due to the fact that their prices are usually affected by changes in earnings. Because of their high volatility, growth investing is most appropriate for investors with a high tolerance for risks. On the other hand, value stocks are less volatile than growth stocks. The idea with value stocks is that they take a longer time to experience a turnaround. This length of time makes them less likely to fall in value. This is also the reason why value stocks are best suited for long-term investors. They do not experience price fluctuations, unlike many other securities found in the stock market. They also have a proven record of success. The low price for which the stock is acquired is interpreted by the investors as a monetary glitch. If the stock did well in the past, it will also experience a turnaround in the future. The fact that investors also have faith in the company sometimes helps it bounce back faster. However, value stocks also carry risks of their own. For instance, if the manager miscalculates the intrinsic worth of any stock, it backfires. Thus, if the assessment of the company's future prospects is off, then the current value of the shares may not reach the projected value. Simply put, there is no guarantee of profit in both value investing and growth investing. Growth stocks historically perform better than value stocks when the rate of interest falls. They also perform better when the earnings of a company are on the rise. Conversely, they are usually hit the worst when the economy experiences any downturn. Growth stocks are more expensive than value stocks. Investors place a lot of expectations on growth stocks. This expectation drives up the prices of the stocks themselves. Their prices are high, especially when compared with their sales or expected profits. Investors are expected to pay higher sums for growth stocks than value stocks. This is because they have the expectations of selling it for a huge profit later on. The idea is that as the company continues to grow, so does the money worth of the shares of such a company. Growth investors make excellent bargains because although the stocks are expensive, they are sold at a much higher price later. Value stocks are always the cheaper of the two stocks. Investors purchase value stocks because they are undervalued in the market. Value stocks, as defined, are stocks trading for lower than their fundamentals. The price placed on a value stock is usually determined after analysis of several factors. These factors reveal the intrinsic worth of the stock, and the investor judges that before investing. Some of the factors taken into consideration include the business model employed, the market, competition, etc. For a long time, there has been an ongoing argument about which of the two forms of investing is the best. The two sides have always managed to come up with statistics to back up their claims of superiority. The argument in support of value investing is that both for long and short terms, the yield supersedes those of growth stocks. Some studies have revealed that over a longer time frame, value stocks fare better than growth stocks. Also, the same can be said when the time frame is relatively short. In the short term, the market value of individual shares can be pushed quite low. This provides the perfect investment opportunity for value investors. Some individuals prefer to do a combination of both strategies when investing in the long run. The intention with this is to receive the highest measure of returns while encountering minimal risks. This smart move is designed to favor the investor in the event that the market favors growth or value investing. A combination of both strategies guarantees a smooth return in investments. Finally, on the question of which strategy is better, a definitive answer may not be possible. However, studies have shown that value investing is the better of the two for long-term investments. Growth investing, on the other hand, offers higher short-term returns. Whatever style you choose to employ is up to you. You have to consider the time frame you have and the funds available before choosing a strategy. Chapter 3. Skills needed by value investors. A dose of healthy skepticism. A dose of healthy skepticism is required by every investor. In fact, Robert Johnson, president of the American College of Financial Services, stated that it is one skill every investor cannot do without. Understandably, the skill doesn't mean that the investor becomes cynical or pessimistic. What it entails is the investor understands that something may eventually go wrong. The process of preparing for this eventuality is what informs the skepticism. One other skill the investor requires, which closely resembles healthy skepticism, is contrarianism. Value investors are often bold and audacious people. They are never afraid to go in the opposite direction of the herd at any point. With this, however, there is the danger that the investor may become misled as a result of conceit. If the investor constantly continues to follow in his own path, he may not even realize the times he's done something wrong. To prevent this from happening, it is advisable for the investor to be in tune with his figures at every turn. The decisions he makes should be guided by knowledge of the financial market as well as a reflection of his thoughts on his own position in the stock market. To ensure that his decision to invest in the opposite direction of the stock market is the best in this instance, he needs to carry out an analysis. The investor needs to ignore the opinions of everyone else around him, consider the figures, and make his decision. Every decision should be singularly evaluated. Great value investors make it a habit to revisit their position once in a while to determine its continued relevance. It may be required for you to recalculate the intrinsic value of any stock. Do not hesitate to do so. In the event that there has been a change in the company's prospects, the investor needs to make the proper adjustments for that. Patience. There is no gainsaying the fact that every investor, especially a value investor, needs to develop patience. From the very beginning, patience is required while identifying the opportunities to invest. When the investor has found stocks to invest in, he will also need to develop patience. As stated earlier, the value investor always has the need to wait for the stocks to mature. When a value investor is purchasing a stock, he knows that his rewards will not be immediate. He postpones present enjoyment of the rewards until a future date. The most important skill for any investor is the ability to stay on the sidelines and wait for the appropriate time to invest. When the investor decides to purchase a particular stock when its intrinsic value is at a particular margin, he needs to stick to it. It will make little sense to make the purchases at a 5 or 10% discount. The investor needs to wait for a higher margin of safety to be built into the stock before purchasing. The margin of safety required is up to 30% at the very least. And for this discount to be achieved, the investor needs to have an armload of patience. One of the means through which the investor develops patience is through experience. Reading and getting advice from people will only do so much. There is no substitute for real, hands-on experience. At the onset, when the investor starts investing, the market will exert a pull on him. It is often required that a person who has built some level of acumen be the one to engage in the first trade for the investor. The experience this latter person has garnered will go a long way in informing the choices the new investor will make. As mentioned earlier, patience is usually a function of experience. For the investor to build his experience, and by extension, patience, he needs to start small. By taking small risks from the onset, he will be able to manage fully the outcomes of his investments. Finally, one of the products experience births is a conviction to stand by your decisions. The investor is able to stand by his decisions when he has a strong conviction about them. This is usually strengthened by the many years of success he may have experienced in the field too. Persistence. Persistence is the ability to keep showing up no matter how hard it gets. It is the ability to do the same thing over and over again with the expectation of results. Persistence is a skill no investor can afford to do without. The task of investing can be quite boring. However, the investor needs to always show up and keep working hard. There are numerous articles to be read and calls to be made in the pursuit of investing. The investor cannot afford a break in routine or a deviation of any sort. This is because success is often enmeshed in small routines. Even in the instances where they experience any failures, good investors know to get back up and continue. There is no room for self-pity or do-overs. Persistence requires a great amount of discipline. Adam N. Phillips, director of the portfolio strategy at EP Wealth Advisors in Los Angeles, believes that this is the most important skill for any investor. The ability to keep doing the same thing over the years can only be birthed through discipline. Also, valuable information will always get to the investor through a multitude of sources. The information will often postulate when the best time is to make purchases, when to sell stocks, and the likes. It takes discipline for the investor to disregard all of those factors and stick to his investment strategy. Sticking to a strategy is the only guarantee for success. As a new investor, you will need to be disciplined and also persistent. It may be difficult sticking to a particular path in investing, but that guarantees success more than anything else. You also need to put in the effort to be successful. It may look like mundane things do not matter, but they actually do. Once you realize that the little things are often the difference between success and failure, it will give you the nudge you need. Ability to stay in tune with changing times. It has been mentioned already that value investors go against the tide. However, this does not mean that they totally disregard the principles and guiding policies in investing. Also, it does not mean that they disregard changing economic climates. For a value investor to disregard any position, there is the supposition that he is aware of the position. This is what differentiates an experienced value investor from a new entrant into the investment market. Any value investor who has the aim of being successful has to keep an eye out for changing policies. The policies, for example, could be in the economic sector. It could also include reforms made by the government which impacts the stock market. This alertness will inform the investor when he needs to change positions. It will tell him when to buy or when to sell his stocks. There is no change that is so minuscule that can be overlooked. The truth is, the change that may cause the value of a stock to come crashing down may be so quick that an investor who isn't alert may miss it. The investor needs to understand that, even though he doesn't need to check his stocks every day. He does not leave anything to chance or to the whims and caprices of the stock market forces. To this end, even when he is taking a vacation, he needs to employ someone to keep an eye on his investments. It is always advisable to have an active plan in place if you are going to be off the grid for a while. This person must be someone who is investment savvy and will inform you of any changes. You could arrange it in a way so that the person will act as your proxy, making decisions for your stocks in your absence. For this last option, the person needs to be someone whose judgment you trust. It should be someone you feel comfortable enough leaving your investments and power of attorney with. Of course, it could be that eventually he may not even need to exercise that option, but it is always better to be safe than sorry. A value investor works with a definite plan. One of the distinguishing factors between investors and speculators is the presence of a plan in the former's investing strategy. An experienced value investor does not make any investment on a whim. He carefully calculates each move before finally deciding which stocks to purchase. After the purchase, he still has to decide how long he will keep it and when he plans to sell it. Having a good feeling about a company is common. However, for the value investor, that is hardly a viable reason for purchasing the stock. He will do a thorough review of the strengths, weaknesses, and antecedents of that particular company. He is also expected to carefully inspect all of the options before settling on one. This is the system that should be followed by every value investor, including new entrants. Established investors always have their strategy mapped out in their head and will stick to it. But for the investor who is new to the system, it might be a little difficult to map out a strategy and follow it through. It is for this reason that it's always advisable for a new investor to consult an advisor when he first begins investing. The role of the advisor will be to inform him of the different options available to him. An advisor will also guide the investor through the entire process of investing. In the end, however, the choice of stocks to be purchased will be that of the investors. Hard work. The principle of hard work is applicable in every sphere, including investing. Larry Lockwood, the Stan Block Endowed Chair in Finance at Texas Christian University, Neely School of Business, holds the same belief. He penned the phrase that there is no substitute for hard work. This philosophy is one followed religiously by investors. From the very beginning, great investors conduct due diligence. They do not leave anything in the hands of a third party. If there is anything to be read, they read it. If there is any conference call to make, they make it. They refuse to be distracted by what public opinion is concerning any company or any stock. They form their own opinions of themselves without laying much emphasis on the outside world. The effect of this is that they are never easily swayed by the happenings around them. They are aware of the happenings, of course, but they form their own opinion based on external sources. Great analytical skills. Every great value investor has great analytical skills. The success of the investments depends on the ability of the investor to ingest and analyze loads of information. This is a skill the new investor needs to have. When you hone and develop your analytical skills, it will help you discern wrong data. It will also help steer you clear from misleading information regarding the stock market. Ability to take any loss in stride. Heads up! You're going to lose your money at one point. The fact that you are a value investor does not totally remove the risks from you. There is always the off chance that despite your best calculations, something may go wrong. The investor needs to be aware of this and thus take appropriate measures to ensure this isn't his fate. It would be foolhardy to believe that every investment you make will bring you profits. That simply is not how the system works. Every seasoned veteran, such as Warren Buffett, have strings of unsuccessful investments lining their trails. In some instances, the mistake could be yours. You may make some mistakes while calculating the intrinsic worth of the stock. In some other instance, the mistake could come from the company itself. It's possible that the company made a mistake, effectively dragging your investments down with their mess. Furthermore, the cause of the misfortune could also be natural disasters such as famine, wars, etc. These are factors no single person can easily foresee or prevent. These ones are totally out of your control, so you need to make sure to remind yourself to take it in stride. Finally, it might even be that the investment just did not work out. In this sort of situation, the loss may not be attributable to any external factor, the company, your bad judgment, etc. You need to be prepared in the event that any of the above scenarios happen. There are several ways you can prepare for this sort of situation. One of them is through making alternative arrangements for what your reactions will be in the event that you suffer a loss. It is always advisable not to put all of your money into the investment. You are expected to set some funds aside to be used to handle situations of emergency. You must always be willing to go back to the investing table even when you suffer a loss. This is the only way through which you can truly win. A positive mindset and outlook can do wonders for your psyche in this sort of situation, especially if the loss is on a monumental scale. Finally, do not spend all of your time trying to avoid a loss. It is almost impossible to avoid a loss as long as you are investing. The best you can do is to try to reduce the rate of losses to the barest minimum. Most importantly, trying to avoid a loss will keep you solely focused on the loss, and in that way, you may never win. Do not be cautious to the point of avoiding risks that will potentially lead to successes. As an investor, always keep your eyes on the prize. Do the best you can, and leave the rest to work itself out. Chapter 4. Fundamental Analysis. Fundamental analysis is the lifeblood of investing. As a matter of fact, any individual who invests without a thorough knowledge of fundamental analysis is bound to fail. Whatever investment strategy you choose to employ, it will most likely rely on fundamental analysis. With relation to stocks, fundamental analysis tries to determine a security's value by considering underlying factors around it. These factors, which surround the company's actual and future business prospects, are considered before arriving at the value of the stock. Fundamental analysis involves the examination of the underlying factors that determine a company's well-being. The goal here is usually to predict the future price of the stock. Fundamentalists usually disregard the forecast of random individuals in the stock market. It is possible to perform fundamental analysis on an entire economy or industry. This is because, broadly speaking, fundamental analysis analyzes other factors within an industry, apart from prices. Price movements are usually given the least consideration during fundamental analysis. In performing fundamental analysis for the industry, the analysts check the supply and demand forces. To assess the economy generally, the analyst here focuses on the economic data available to the individual. The data is then used to determine the present state of the economy and projected growth. In arriving at the future prices of stocks, fundamental analysis combines both the economic, company, and industry analysis. Ultimately, fundamental analysis comes down to the question of whether or not the stock is a good investment, the company is growing, and whether profits are actually being recorded. Finally, it considers if the company is currently mired in debts. Fundamental analysis can be described as the researching of the fundamentals of any company. The question then becomes, what are fundamentals? This is quite a tricky concept to define because the fundamentals of a company could include a lot of things. It could stem from obvious factors such as revenue generation, profits, and even include such factors as the quality of management. Fundamentals are basically grouped into quantitative and qualitative. Quantitative fundamentals are the visible, discernible characteristics of any business. They include measurable data such as the amount of revenue generated. Qualitative fundamentals are not that easy to pinpoint. They are the intangible aspects of a company that influence its growth. This may include the company's reputation, leadership style, etc. There are two primary criticisms of fundamental analysis. These criticisms come from those who subscribe to fundamental analysis and those who believe in the efficient market hypothesis. Simply put, technical analysts make investments simply based on the price of the stock. They do not consider the fundamentals while making investments, basing solely on momentum. They believe that all the information about the market is reflected in the stock. Thus, the movement of the stock provides more information. The disagreement for the proponents of the efficient market hypothesis comes from both technical and fundamental analysts. They believe that it isn't possible to make huge returns in the financial markets in the long run. They do not care if the tools being employed are technical or fundamental in nature. Goals of fundamental analysis. The goals of fundamental analysis, when employed by different persons, varies. However, generally, there are specific reasons why an investor will want to engage in fundamental analysis. They include determining the fair value of any stock. Fundamental analysis makes searches throughout the entire stock market to determine future price movements. These predictions will be based on the behavior of the stock market within that specific period. Also, the analyst tries to determine the worth of the company and whether its stock is overvalued or undervalued. This will then inform whether the value investor will purchase the stock or not. A value investor will only purchase a stock if it is currently undervalued. When the price eventually matches its intrinsic value, the value investor will then sell for profit. Determining what the financial strength of the company is. The most important task of the analyst is determining the financial strength of the company. Here, the analyst determines if the company has the capacity to pay off its debts. Every other factor is irrelevant if the company is mired in debts it cannot repay. Individuals often make the mistake of researching the stocks after they have purchased them. That is a very unwise move to make. People often skip the research part because it takes a measure of effort on the researcher's part. It's important to take the time to go through the financial records of a company before arriving at a conclusion. Fundamental analysis will help the investor avoid this mistake. If he carefully sticks to the principles of fundamental analysis, he will eventually be able to uncover hidden issues within the stocks. Analyzing a company's competitive edge. It is not just enough to try to determine the strength of the company alone. Analyzing the factors regarding a company in isolation will give a jaundiced view. The fundamental analyst is supposed to compare the company with others in the same sector. The company is then analyzed with others in the same industry. The benefit of this is that it will give a better, more cohesive view of the company. It also gives the investor a fair idea of how the company will fare against others. The truth is that the company will be going up against several others in the same industry. Fundamental analysis is aimed at giving an investor a fair idea of how well the stocks will eventually do. So, before investing, the investor should know whether the company can beat its competitors. The overriding aim of fundamental analysis is to empower the investor to make the best possible investment choice. Basics of fundamental analysis. When conducting fundamental analysis, the investor has to bear the following in mind: an estimation of a company's value. Perception affects the financial markets. Investors may consider a particular company, yet arrive at different conclusions regarding its potentials. One may be seeing a potential gold mine, while another will be seeing a financial risk not worth taking. The perception of any stock may be influenced by sentiments. The truth is, in certain situations, the forecast concerning a particular stock is influenced by sentiments. This is why, in many instances, stocks sometimes exceed their valuations. Also, in other instances, the stocks do not even meet the expectations. This is especially true in weak markets. Great fundamental analysts disregard the market perception about stocks and develop their own systems. They make use of the financial metrics of the companies. This is based on the understanding that it may be impossible to put a specific price tag on assets. Industry trends affect the value of stocks. Stocks are delineated based on their particular sectors and industries. Thus, to understand the strength of any company, it should be viewed alongside stocks within that same industry. Generally, a strong industry will yield stocks that are also very strong. It is through this process that industry trends are birthed. An investor needs to be aware of the industry trends within their own industry. Your industry is the one you intend to invest in, or that you have already made investments in. To understand an industry's trends, look at the leaders of the industry you're interested in. Chances are that how they respond to different situations will set the trend for the industry. Fundamental analysis works best for long-term investors. Long-term investors are the ones who benefit the most from fundamental analysis. This is because investments reach a peak of profitability in the long run. Swing traders do not profit as much as long-term traders. Their profitability is hinged mostly on their premise for holding. As for intraday traders, their profit margins are even smaller. They are usually affected by news in the industry and may not be stable enough to benefit from fundamental analysis. Fundamental analysis for different securities. Fundamental analysis is used when referring to particular stocks. However, it can also be employed in the evaluation of different securities, such as bonds and derivatives. The important thing to note here is that as long as economic fundamentals are being looked at, fundamental analysis is being engaged in. Fundamental analysis makes use of data available in the public domain to come to a conclusion on the value of the stock. Fundamental analysis is used mostly for the evaluation of stocks. However, it can be employed in the evaluation of any sort of security. For bonds, a value investor can decide on the value of the security by paying attention to several economic factors. This may include looking at the interest rates charged for security all over the country. The state of the economy is also a factor to be considered here. The value investor also needs to take notice of the individual who issues the bond, such as the bond issuer. Factors such as the potential changes in credit ratings may make all the difference. When evaluating stocks and equity instruments, the analyst makes use of revenues, earnings, profit margins, etc. These factors are used to determine the company's value and its potential growth also. In regard to stocks, fundamental analysis takes into cognizance the financial statements of the company being evaluated. A value investor will always buy stocks whose intrinsic value is higher than its market value. This is because the investor is aware that the value of the stock will eventually rise. Stocks often rise to move towards their intrinsic value. This same principle applies when the intrinsic value is lower than the market price. In this instance, the investor will have to sell the stock. The principle remains primarily that the value of a stock gravitates towards its intrinsic value. There are several stages in the fundamental analysis of stocks. The first step involves the initial screening of the stock to determine compatibility. The investor has to be aware of several ratios which come into play in evaluating any stock. The role of the ratio is to inform you of the financial health of the company. The way this works is through comparison with other ratios in the same industry. When the ratios of these different companies are pitted against each other, they begin to reveal information about that particular company. Some of the ratios that are considered in fundamental analysis will be discussed further. The first is liquidity ratio. Liquidity ratio is used to calculate a company's liquidity position at every moment. It assesses the ability of the company to change its assets to cash at any time. The liquidity ratio is important because it is through this means that the company pays off debt instantly. Thus, a company with a high liquidity ratio will have the ability to pay off its debts faster. The liquidity ratio is usually calculated by dividing a company's current assets with its current liabilities. Another ratio is the company's profitability ratio. The profitability ratio simply analyzes the ability of a company to rake in profits. What it does is to show the financial standing of a company at any point. Some commonly used profitability ratios include the operating profit margin, the return on equity, etc. There is also the activity ratio. This merely assesses the operations within the industry. It pays attention to how efficient or otherwise the operation within the company is, and it's the ability to quickly convert inventory to cash. Price-to-earning ratio shows the company's share price to its earnings per share. This could be an excellent way of determining if the company is overvalued or undervalued. You should bear in mind that companies could easily alter their price-to-earning ratios by adding debts. Thus, it is always advisable to make use of a company's past ratio to gauge its present price-to-earnings ratio. The second step in analyzing the fundamental analysis of any security is by learning about the company. You can hardly be in a position to determine the health of a company if you are unaware about the information available about the company. You should know what will happen if there is a sudden dip in the price of the company's products. Also, how about a change in management? How will it affect the company? It is advisable to visit the company's website to carry out this research. You need to carefully peruse what the vision of the company is. You need to check how well they have performed over the years. All of these combined will help to determine if you will be moving on to the next step. It will notify you whether you will end your search at this point. If you are satisfied with the information you have about the company, then it is time to move on to the next stage. The third stage is checking the financial reports of the company. This is one of the most crucial steps in the fundamental analysis of any company's stocks. The financial reports include the profit and loss account, cash flow statements, etc. The balance sheet tells you the current debts and assets. The analysis of both the assets and liabilities will provide insight and information about the company. Another financial report which you should take into consideration is the company's annual reports. Annual reports are filed every year by any public limited company. They are also made available for public consumption. The documents are usually voluminous and take up a huge portion of an investor's time. The last financial record to be checked is the company's cash flow statement. As the name suggests, it simply shows the cash movements within the company. What this shows you is the liquidity of the company at any point. This information can be very helpful to the investor. After considering the financial records, the next step in the fundamental analysis of the stock is checking the company's debts. A company's debt can play a huge role in determining any future prospects. This is because a company with large amounts of debt will only focus on paying off their debt. The shareholder can hardly reap from the company in such situations. Finally, the last step in the fundamental analysis of stocks is checking the company's future prospects. If your intention is to invest in the long term, then you need to be sure the company will last as long as you intend for it to. You should be happy knowing that the company will still be around in the next 10 to 15 years. You should also analyze the company in relation to its peers. When considered with other companies in that particular field, does it perform well? Why are you going for this particular company against the others? What is unique about this company? Fundamental analysis of a particular stock is quite important to the value investor. The factors considered here are used as a basis for whether or not you should invest. The rules stated here are not cast in stone. The investor can deviate from them. The ultimate goal is to provide a system for optimization of profit for the investor. Importance of fundamental analysis. From all that has been discussed, it is easy to realize that fundamental analysis is important in investing. However, a lot of investors still fail to understand just how important fundamental analysis is. So, for the purpose of emphasis, I will attempt to discuss the importance of it. Fundamental analysis gives you an understanding of how the system works. It grants you a deep understanding of the factors that influence the growth of stocks. It also lets the investor know the reason for the rise and fall of the prices of stocks. Armed with this knowledge, the investor is able to make better decisions and make better returns. However, the technical analyst merely tries to analyze the stock with the use of statistics only. Technical analysts believe that the future patterns of price movements can be determined by looking at the past. The data used in technical analysis is generated over a short period of time. The fundamental analyst, however, uses the information generated over a long period of time. It has often been argued that the information generated from a technical analysis may be unreliable. This is because of the short length of time the research is based on. There is also the criticism of its efficient market hypothesis. This is the assumption that all that is to be known about the stock is reflected in its price. Finally, a combination of fundamental analysis and technical analysis can be done. Here, the investor may choose to employ fundamental analysis to determine stocks with strong fundamentals. Thereafter, technical analysis will then be employed to determine the best price to pay for them. Also, fundamental analysis can be employed to discover stocks that are undervalued. Primarily, that is the reason fundamental analysis is employed in the first place. After this, technical analysis is then used to determine the best entry and exit points for the investor. In the same vein, technical analysts may also employ the help of fundamental analysis in order to make great trades. The technical analyst may have the intention of selling the stocks within a specific time frame. He will then have to make use of fundamental analysis to be sure the stocks will yield profits in the future. A lot of investors do not believe fundamental analysis and technical analysis should be combined. These sets of investors believe the two concepts are opposing concepts and should be left so. Whatever the case may be, it certainly helps the investor to know how both systems work. This will, of course, help him in finally determining which of the two to employ in the future. There is also the suggestion to employ fundamental analysis, technical analysis, and qualitative analysis. This may be a little too tedious for the investor. It's best for the investor to employ whatever method they are most comfortable with. Chapter 5. The Graham Way. It will be an aberration to talk about the art and the scientific study of value investing without mentioning Benjamin Graham. Warren Buffett might be the poster boy of value investing, but his great strides in value investing will have been virtually impossible without Benjamin Graham. He is often described on Wall Street as the father of value investing and the dean of Wall Street. Anyone who intends to have remarkable success in value investing must be a student of this great man. Of course, being his student in this context will refer to studying his works on value investing and implementing the evergreen principles engineered by him. He is seen as the pathfinder in the business of security analysis. Modern investors are still benefiting from the works of this great man who left an indelible mark on the world. Two of his best works, Security Analysis and The Intelligent Investor, which were written in 1934 and 1949 respectively, are still being widely read today. He was gifted with the uncanny ability to analyze a company with surgical precision. This enabled him to accurately predict the likelihood of the rise or fall in stock values in the future. The Securities Act was enacted in 1933, with him playing a prominent role. This act was a game changer. This act required that companies provide financial statements subjected to the scrutiny and approval by an independent accountant. The resultant effect of this was that it made it easier for him to carry out extensive financial analysis of various companies accurately. Benjamin Graham. Who was he? Benjamin Graham was an American professor, economist, and investor. He was born in Britain and lived between 1894 and 1976. He mastered the art of making money by buying stocks for less than their intrinsic value. He did this in order to sell them later when they are properly valued or even valued beyond their intrinsic value. Graham was famous for this, but that was not all. He also had various people who learned from him. He graduated from the Columbia University in New York, where his academic prowess was indeed remarkable. After his graduation in 1914, he started working on Wall Street. He started making money, but lost most of it in 1929. This was as a result of the stock market crash that took place that year and eventual depression. He also made a living from mentoring people and writing books on value investing. Among his renowned students is the poster boy of value investing, Warren Buffett. Benjamin Graham may have passed away, but his principles live on. Blessing in disguise. Being able to learn from past experiences to improve one's life is a smart move. Graham displayed this in a considerably impressive manner. The lessons he learned from the terrible occurrence in 1929 was what gave birth to his famous book, Security Analysis, published in 1934. The book became a standard used to teach finance-related courses for several years. His method of analysis and evaluation of securities began here. He was determined never to suffer the same fate again. He was also determined to help other people avoid the same fate. He started developing his world-renowned method of taking low risks and getting huge profit. He did not simply just write another economics theory on finance management book. The book contained many theories which he had tested himself. Practice before theory. Before he wrote the book, he had invested in companies he had personally studied. He observed that the liquidation value of these companies was higher than the price at which they traded their shares. In other words, he bought shares from the companies who sold shares for almost half the price of the true value. In clear terms, if he felt that a share was truly worth $6 and it is being sold for $3, he will quickly seize the opportunity to buy said share. He noticed that people in the market are unnecessarily scared and unreasonably greedy. These two attributes were important to the success of Graham's method of analysis of the market. He noticed that companies sell off shares for their true value when they are afraid that they run a risk of liquidation. Hence, he mastered the art of pouncing on such lapses. A generous heart. Once he had some level of consistent success, he felt the time was right to share his discovery with the world. That was what gave birth to the book. One of the key characteristics that exude the greatness of Graham was his willingness to share his business ideas with others. Typical businessmen and women are often careful to let others know about their winning formula. They often consider thriving business ideas as classified top secret. Graham never saw it that way. Warren Buffett, in particular, extolled his mentor for this attribute. Interestingly, Warren Buffett was just 19 years old when he read The Intelligent Investor. He was thoroughly impressed by the content of the book, but much more than that, he was impressed by the fact that anyone would be generous enough to share such great business ideas with others. Buffett became convinced that studying under such a brilliant and generous mentor will be worth it after reading the book. He achieved this by enrolling into the Columbia Business School. He eventually became Graham's employee. This was the beginning of the famous friendship both of them shared that lasted all throughout Benjamin Graham's lifetime. The company was called the Graham-Newman Corporation. Buffett worked for Graham for 2 years until Graham decided it was time to retire and called it a day. The success of Benjamin Graham, both as an investor and as a teacher, made his a larger-than-life personality worth of emulation. He saw life as being worthwhile when others benefit from what you have. This rare mindset is indeed commendable. He believed that the world will be a better place when successful people are generous with their process. Most people only talk about their success, but never the process involved in achieving success. This mindset was also what made him publish The Intelligent Investor in 1949. The book remains one of the best-selling books on investment today. The amazing ideas in the book are still evergreen and relevant in the financial world until today. Warren Buffett described the book as being by far the best book ever written on investment. The work contains ideas that look simple on the surface, but are, in fact, very powerful. Only a few people can match Graham's amazing ability to combine simplicity with effectiveness. To further support his commitment to humanity, Graham spent most of his retirement years on the development of simplified means of successfully maneuvering the market for investors. New investors were his major audience. He wanted to ensure that no new investor ever makes the same mistake he made earlier in life. His works on value investing are more than mere theories from a brilliant mind. They were golden nuggets from a caring heart. Warren Buffett is also doing the same thing today. He is indeed a true student of his teacher. Value investing the Graham way. One of the important teachings of Graham is the freedom of the investor. He explained this by introducing an imaginary person who he called Mr. Market. Mr. Market, according to him, should be perceived as a business associate with whom you have business transactions. This business transaction deals with the buying and selling of assets. According to Graham, Mr. Market's prices make sense, but can go above or fall short when you consider the economic situation at that point in time. He described the investor as a free person who should not be pressurized to make any decision. You might end up regretting the decision you made hastily because you were under pressure. He opined that the reason why the investor should not be under any pressure to make decisions hastily is that Mr. Market will always come around with another offer no matter how many times you ignore him. Hence, the investor can wait for the offer that comes with low risk and ends with high value in the long run. In other words, According to Graham, you must realize that there are many deals that will come to you as an investor. You don't have to be in a hurry to buy or sell. Wait to pounce on the offer that has low risks. This ensures that you will have virtually nothing to lose in case things go wrong, like they have the tendency to do in business. This method of viewing the market was described by Benjamin Graham as the use of market psychology. He is of the opinion that there is the psychology of the market which any investor who wants to succeed must understand. Failure to understand this market psychology will make you lose out to Mr. Market more times than you will ever gain. Dollar cost averaging and investment in stocks and bonds. Benjamin Graham was able to paint a perfect picture of the volatility in the emotions of the stock market. An intelligent investor, according to Graham, sees this volatility as an opportunity rather than a reason to press the panic button. He is of the opinion that some stocks are undervalued simply because the stock market is depressed. It takes an investor who is not carried away by these emotions to pounce on the opportunity to buy low-risk stocks. Graham postulated two techniques that are needed in order to be able to cope effectively with the volatility of the market. The first one is dollar cost averaging, while the second is an investment in equity or debt instruments. Dollar cost averaging is attained when you choose to purchase the same amount of investments in dollar terms at regular intervals. This enables you to take advantage of the reduction in the price. More importantly, this ensures that you will not be worried about purchasing your entire position when the market reaches its peak. This technique is suitable for investors who are passive. The advantage this gives them is that they don't have to get worked up concerning the appropriate moment or price at which their position should be bought. Investment in debt and equities is a good way to preserve your capital while ensuring that it grows steadily, according to the Dean of Wall Street. He recommends that 25 to 75% of your investments should be in bonds. The variation for this should be based on your own evaluation of the current market situation. An important advantage this approach gives you is that you will not feel bored as an investor. The temptation to be actively involved in trading is the reason so many investors end up losing their money. Hence, in order to eliminate this boredom, investing in bonds is the way to go. The margin of safety. The ability to say no is an important advantage the investor possesses. Hence, there is no reason to rush into any deal. He believes that a proper evaluation of the current valuation of securities will offer the investor the opportunity to pick only the best deals. This introduces the concept of the margin of safety, which is a vital concept for students of Benjamin Graham. The margin of safety, according to Graham, is the art of purchasing a stock at a price that is lesser than the fair value of that stock. The advantage of this is that you will then be able to sell it for a higher profit by the time the market returns to its sanity. Sometimes you might even be able to sell it for more than the price that you believe the stock is truly worth. This approach minimizes risk and maximizes profit. You will have nothing to lose in case things don't work out eventually, but have a lot to gain when they do. The margin of safety is core to this remarkable success attained by Graham. It is true that many of his students innovated further and came up with their own ideas. However, the concept of margin of safety remains the backbone for whatever innovation they came up with. Know yourself. Graham reckoned that one of the greatest evils an investor can do to him or herself is not to know the kind of investor he or she is. Hence, it is imperative that you know the kind of investor you are. He explained this by introducing a comparison of different kinds of investors that exist in the stock market. The first is the active versus passive investors, while he also distinguished between an investor and a speculator. Active versus passive investors. Graham called active investors enterprising investors, while passive investors are defensive investors. Most investors in the investment world equate risk with returns, but this was not the case for Graham. He was convinced that it is the amount of work put into an investment that determines your return and not just the fact that you are taking risks. Hence, when it comes to the amount of work and energy put into an investment, Graham describes the active investor as a person who invests a whole lot of energy and time in order to become a good investor. Such a person expects a high return from this commitment. He, however, described a passive investor as a person who is okay with low returns and only commits a measured amount of time and energy to invest. An active investor puts in a lot of time into research in order to invest correctly. However, if you are a passive investor who is not ready to commit quality time to research but still wants to make good returns on low-risk offers, it will be better for you to invest in an index. To further illustrate this, Graham explained that a passive investor can simply invest in 30 stocks of the Dow Jones Industrial Average and obtain an average return in equal amounts. This looks simple and easy, but not for Graham. Warren Buffett, just like his teacher, also endorsed this line of thought. An average return should be treated as an accomplishment rather than a routine. A lot of people are of the opinion that they can easily get an average return by simply investing in an index. Such people believe that just a little more commitment will bring them higher returns. From the experience of many people, it is not that easy. So many people have lost money with this line of thought. Graham's definition of a defensive investor in this modern world is a person who invests in index funds of both bonds and stocks. Such people can be safely seen as the ones who own the entire market. This is because they are able to effectively gain from the best performing areas of the market. They also will not have the burden of the prediction of such areas beforehand. This approach will help you be a beneficiary of the returns of the market consistently. You can be sure that you will not have lesser than average returns. You simply allow the overall result of the stock market to decide returns in the long haul. Hence, don't assume that it is an easy task to take advantage of the market structure. Many have told this line, and they have lost out to the market badly. This happens to some people consistently. You don't have to be one of such people when you listen to those who have succeeded in the past. Investor versus speculator. Graham pointed out that it is not everyone in the equities market that deserves to be called investors. He observed that some people are best described as speculators. The key difference between an investor and speculator is that the former perceives the stockholder as one who owns the business, and the stock is viewed as part of the business. However, the latter perceives him or herself as someone who is just toying with pieces of paper that are expensive and has no intrinsic value. It is what will be paid for the asset that determines the value it has, as long as the speculator is concerned. Graham's number. Benjamin Graham developed what is called Graham's number. It is also sometimes called the Benjamin Graham number. He developed this technique in his bid to ensure that his clients and students are able to maximize their margin of safety. Graham's number refers to the highest value a defensive investor must not go beyond when valuing and purchasing an asset. Graham's number is calculated by considering the book value per share of the company and the earnings per share of the company. Once calculated, any stock price that does not exceed this value is within the investor's margin of safety. Hence, such stock is considered worthy of your investment. This is because that stock is given a value lesser than its true worth. Hence, it will offer the decisive factor for investment straight from Graham's book, Low Risk and High Profit Potential. Graham's number can be regarded as a general test that enables the investor to take advantage of a worthwhile stock. Graham believes that any price-earnings ratio that can be considered worthwhile must not be higher than 15. He is also of the opinion that the ratio of the price to the book must not be more than 1.5. This explains why the formula for calculating Graham's number is 22.5, 15 times 1.5. In conclusion, Benjamin Graham had a larger-than-life personality which survived an unfortunate circumstance through sheer determination, analytical brilliance, and financial intelligence. His survival techniques have given birth to value investing theories that are still relevant today despite his demise. His story is inspiring, and his works are revolutionary. Chapter 6. Security Analysis. Whatever you don't understand will sound difficult to you. Security analysis is not a complicated concept when understood in its proper context. Therefore, what is security analysis? Security analysis involves the use of information made available to the general public to analyze and evaluate warrants, assets, equity, and debts of companies. It is the evaluation of factors that have the ability to determine the value of a particular asset. This is done if an investor is able to make the right decisions when investing his or her hard-earned money. Of course, the right decision will mean the maximization of profit and minimization of losses. This technique was made popular by Benjamin Graham, who wrote Security Analysis. Securities are financial instruments that can be traded, such as bonds and stocks. They are assets that have financial values attached to them. Securities have three general classifications: equity securities, debt securities, and derivatives. Equity securities are the financial instruments that distinguish those who own the company from others. In other words, the assets and profits of a company belong to those who have bought the equity securities of that company. Debt securities are assets that can be traded between individuals. They often have terms and conditions that are clearly defined. The maturity date, rate of returns, principal, and interest rate are also clearly defined. The derivatives are basically assets in which the payments that are made between two parties have conditions specified. With derivatives, there are no ambiguities that might lead to future issues when the payment is to be made. The two parties involved are already in consonance concerning the conditions of payment before the transaction is carried out. Hence, security analysis can be described as the valuation of bonds and stocks until an investor is able to have a good grasp of the intrinsic value of the bonds or stocks. Credit derivatives that can be traded are also referred to as securities. It is, however, noteworthy to observe that future contracts, as well as commodities, cannot be referred to as securities. The reason for this is not far-fetched. It is simply because the performance of these two is not dependent on the actions or activities of a third party. What is often described as securities that are related to contracts are the options that are available on these contracts. Interestingly, it was the decision of the United States Supreme Court in the case of SEC versus W.J. Howe C. that has defined vividly what can be referred to as security and what does not qualify to be called the same. Types of security analysis. There are various types of security analysis. Security analysis can be fundamental, quantitative, or technical. With fundamental analysis, factors such as the momentum of the stock market as well as the price trend are very important. This is because fundamental analysis focuses on the evaluation of business factors that are fundamental, such as financial statements, market data, competitors' market, as well as other relevant facts and figures. Quantitative analysis involves taking advantage of the indications that are provided by both technical analysis and financial statements. This is usually done by using quantitative data. Technical analysis enables financial experts to analyze and make fairly accurate predictions regarding future price trends by using data from the past. It is, however, important you understand how financial statements work in order to understand how to effectively carry out a security analysis. Financial statements are important tools of analysis for any serious value investor. Financial statements. Security analysis is impossible without financial statements. They are the veritable tools based on which security analysis is carried out. What is a financial statement? It is an official record that contains the activities that have been carried out by a finance company. They convey the financial performance of said company to the general public. In order to ensure that the financial statement provided by a company is accurate, it is often vetted by outsiders, such as governmental bodies, firms, and accountants. The essence of this is to provide viable and reliable background information to ensure that a company does not take part in tax evasions, and also to help potential investors make credible decisions. It is important to note that you don't have to be an accountant to read and understand financial statements. It is as simple as reading the label on a food product. Hence, if you have always thought that understanding financial statements are tantamount to rocket science, you are mistaken. They are not as difficult as you might have thought. Financial statements show you what a company does with their money. It shows you the source of their income, their expenditures, profits, and losses, if any. Hence, they often contain income statements, balance sheets, cash flow statements, and statements of a shareholder's equity. The assets owned at a particular time by a company is outlined in a balance sheet. The expenditure of the company, as well as their profit over a period of time, is displayed in the income statement. The cash flow statement displays the money that was exchanged between the outside world and a company within a given time frame. The changes that occurred in the interests of the shareholders within a specified period of time is outlined in the statement of a shareholder's equity. The first three tools of security analysis, which are fundamental components of a financial statement, are explained in detail below. Balance sheets. Details of the assets, a shareholder's equity, and liabilities of a company are contained in a balance sheet. In case you're wondering what assets are, they are financial instruments owned by a valuable company. The implication of this is that they can be traded off for financial gains. Besides, they can also be employed in the production of a commodity or in the provision of services. They may be properties such as trucks, plants, equipment, or inventory that are physical in nature. However, not all assets are physical. Non-physical items like patents and trademarks are also considered assets. Aside from these, the investments made by a company, as well as the money a company possesses, are all assets. Liabilities, on the other hand, are the debts that are acquired by a company. Liabilities can be in various forms, just like assets. They can come from the rent, as a result of having to use a company to loan from banks used for various things, such as the launching of a new product, the salaries of the employees of the company, debts incurred by buying raw materials, taxes to be paid to the government, and money spent on the cleanup of the environment. The obligations a company has to its clients to provide goods and services in the future are also considered liabilities. Net worth, or capital, are the other names that are used often to refer to a shareholder's equity. It is the money that will remain in case a company decides to sell off every asset it owns. This is done by companies in order to be able to settle their liabilities. It is the owners of the company or shareholders that own this money. Hence, a balance sheet can be effectively described as a record that contains the assets of a company which is the addition of the liabilities and the shareholders' equity. Looking at the balance sheet, the assets of the company is located on the left side. The shareholders' equity and the liabilities of the company are found on the right side of the balance sheet. This is, however, not always the case. Sometimes a shareholder's equity is placed at the bottom of the balance sheet, followed by the liabilities and the assets in ascending order. The assets are not often arranged randomly. They are often arranged based on the ease at which they can be converted to cash within the time frame of a year. An inventory is a good example of this. On the norm, the expectation of a company is that they should have been able to trade off their inventory within a year. Assets that are not expected to be sold within a year by a company are referred to as non-current assets. Fixed assets are the perfect examples of non-current assets. Assets such as trucks and office furniture that are not available for sale and are used to run the company are fixed assets. The due dates of liabilities are the basis on which they are often listed. Liabilities are classified into long-term or current liabilities. The obligations that are expected by a company to be settled within a year are current liabilities. The ones that have more than a year due date are long-term liabilities. The amount of money that has been invested in the stock of a company by the owners, in combination with the losses and profits of the company since its establishment, is the shareholders' equity. Dividends are the profits of the company that is distributed among its shareholders. A balance sheet will also unveil the way money goes in and comes out of the company. Its sole responsibility is to unveil the shareholders' equity, liabilities, and assets of a company. Income statements. This is the record that is tasked with the responsibility of unveiling the earnings of a company over a period of time. Often this is done annually, but it can even be done before the fiscal year ends. The expenditures of the company during this period of time are also recorded in the income statements. Apart from the earnings, the income statements also show how much of the losses the company had suffered during a specified period. The earnings per share, EPS, of the company is also outlined in the income statements. In case the company chooses to share its profits during a specified time, the earnings per share refers to the amount of money obtainable by each shareholder of the company. It is, however, important to note that it is rare for companies to distribute all their profits at once. What is obtainable is that they reinvest it to increase the revenue of the company. You can perceive income statements as a set of stairs in order to have a better understanding of them. In other words, the total revenue of the company will be at the top. Then the expenditures of the company are deducted from the money for each step until the end. The last step reveals how much the company has truly earned during that time. The amount lost by the company is also revealed, if that is the case. The money the company has made from the sales of their products or services is what accumulates as the total revenue, which can be found at the top of the income statement. The total revenue is often referred to as gross revenue. This is because the expenditures of the company have not been deducted from the money. That is why it is referred to as gross revenue. The running costs and other liabilities are the amount of money deducted systematically from the total revenue. The money the company does not expect to get from sales is listed after the gross revenue. Merchandise returns and sales discounts fall into this category. The deduction of the allowances and the returns from the gross revenue is what leads to what is called the company's net worth. Just like a net, after the removal of the allowances and returns, the money is left hanging. Hence, it is called net revenues. The next section, after the deduction of the running costs from the total revenue, is where you will find the gross profit. It is derived from the deduction of the cost sales from the net revenues. It is also sometimes called gross margin. Just like gross revenue, the term gross is also used as a result of the fact that there are still certain expenses that have to be removed from it. The operating expenses are next. These comprise money spent on the operations of the company. A good example of this is the money spent on the research of a new product or the salaries of the workers. Expenses incurred as a result of marketing also falls into this category. It is important to note that the cost of sales is not the same as operating costs. The key difference is that, unlike the cost of sales, operating costs are not directly linked to the goods and services produced for sale. There is also the deduction of depreciation from gross profit. The wear and tear that some assets like furniture, tools, and machinery inevitably suffer are accounted for in the deduction of depreciation. These assets are used in the long term. The cost of these assets are often spread across periods of usage. Depreciation, or amortization, is the process of spreading these costs. The cost of using these assets is but a mere fraction of how much it costs to purchase them in the first place. Once the deduction of all the operating costs from the gross profit has been achieved, what is left is the operating profit. This is calculated before taxes and interest. Sometimes it is also referred to as the income from operations. The interest expense and the interest income are what come next. It is the money earned by companies as a result of making the decision to keep their money in an account where it will yield interest. It may also be from market funds and other related avenues. Interest expense, however, refers to the money a company remits as a result of borrowing money from that source. In some income statements, interest expense and interest income are separated into two distinct sections. The operating cost is then calculated through the addition and subtraction of the interest expense and interest income. Income tax is then finally deducted, which will derive the net loss or net profit. Sometimes net profit is referred to as net earnings or net income. In a particular accounting period, the net income is the actual amount of money the company has earned or lost. The earnings per share are also part of most income statements. This is calculated by a division of the sum of overall net income by the outstanding shares of the company. The result of this calculation informs you on how much each shareholder of the company will earn in case the company decides to distribute the net income of that company for that accounting period. Cash flow statements. The flow of money into and outside of a company is what is referred to as the cash flow statements. The relevance of this is that a company should not be out of funds, which will be required for its expenses and the purchase of assets. All the income statement reveals to you is whether a company was able to make a profit or not. However, a cash flow statement takes it a notch higher. It lets you know whether a company was able to generate cash or not. However, it changes over time, which is the focal point of the statement of cash flow. It does not focus on the absolute dollar amount during a specified period of time. It depends on the information provided by both the income statements and the balance sheet of the company. At the end of the cash flow statements, what you will get is the net decrease or decrease in terms of cash during that accounting period. The three sections of cash flow statements are operating activities, investing activities, and financing activities. The inflow and outflow of cash that has to do with any of these three activities are what determines what will or won't be included. Operating activities are derived from net losses or net income. This is the first analysis of cash flow statements. Most companies are able to figure out the connection between their net income and the actual cash the company received or spent during the carrying out of operating activities. This is achieved through the adjustment of the net income for all the items that are not cash. The addition of depreciation expenses is a typical example of this. Any cash that was spent or made available by other liabilities and operating assets are also adjusted. The investing activity section reckons with the inflow and outflow of cash as a result of activities that have to do with investment. The second part of cash flow statements contains activities such as the purchase of plant, equipment, and property. It also includes investment securities. For example, the purchase of a property will be specified as a cash outflow that resulted from investing activities. This is basically because it involved the use of cash. In case the company made the decision to trade off part of their own investments contained in its investment portfolio, the revenue generated from that kind of transaction will be regarded as cash inflow. This is because it dealt with bringing in cash for the company. The last section involves financing activities. This is the inflow and outflow of cash from a company as a result of financing activities. Cash inflow, in this regard, is often associated with the sale of bonds and stocks. It can also include any activity such as borrowing from a bank. An activity such as paying back a loan that was secured from a bank will be regarded as cash outflow. As you can see, it is not that difficult to understand financial statements. All you need is a simplified explanation of the way it works. As long as you are willing to pay attention to the details, reading and understanding a financial statement is not a difficult task. Chapter 7. The Value Investor and the Stock Market. A good understanding of the stock market and how it works will help you make good financial decisions. In case you are not adept in the knowledge of what exactly the stock market is, this chapter will be of great help to you. The stock market, also called equity market, is basically a collection of markets and exchanges that allows for the issuance, sale, and purchase of shares. These shares are made available by companies so that anyone in the general public who is interested in buying them can do so. The activity of buying and selling are carried out via over-the-counter or via centralized exchanges. The stock market is a free market where companies have the opportunity to access capital. However, the payment for this capital is that they must allow people from the general public to own shares in their company. This enables interested investors to invest in various companies without running the risk that comes with running the business themselves. Investing in the stock market also guarantees that you are offered the opportunity to make more money without having to get worked up about the day-to-day running of a company. Factors such as high startup costs and high overheads will never be a bother to you. It is more or less resting while your money works for you. You might be wondering how the companies who sell shares to the public gain from such transactions. The answer to this inquiry is not difficult to find. Companies who sell shares give themselves an ample chance of exponential progression. This is because the more shares people buy, the more the worth of a company increases. Therefore, both you as an investor and the company have something to gain from your involvement in the stock market. Don't get excited yet. It is not easy to make a profit from the stock market. In fact, you can even run at a loss while investing in the stock market. How? There is a possibility that the stock you have purchased loses value. In other words, you might be forced to sell your stock for less than the price at which you bought it initially. This is definitely a loss because you are losing part of the money you invested in the stock in the first place. Sections of the stock market. Before investing in the stock market, you need to decide which section of the stock market you intend investing. There are two sections in the stock market, primary and secondary. It is in the primary market that securities are originally created. Companies sell off their shares to interested investors directly in the primary market. The primary stock market is trusted because you get to purchase shares directly from the company selling them. As a result of this, the primary market has more investors who invest huge capital, such as hedge funds and investment banks. The secondary stock market works differently. Unlike the primary stock market, it is the investors who are the chief protagonists in the secondary stock market. In other words, it is the investors who sell off the shares they have bought from the companies directly among themselves. Individuals who are not interested in investing a huge amount of money in the purchase of shares are the main participants here. Over-the-counter OTC market, which is also called off-exchange, is the predominant platform for the secondary stock market. There is no central market, and it can be as simple as an interaction between a broker and a trader. These types of transactions are often carried out via electronic media, such as emails or a trusted platform. It is important to note that this does not include the local stock exchange. They are primarily for stock prices, as well as stocks that have not found their way into the listed stock exchange. Factors affecting the stock market. There are various factors that affect the stock market. These factors are responsible for the volatility the stock market is known for. Volatility in the sense that there could be a sudden increase in the value of stocks, or even worse, a sharp decline. This is what makes the stock market a place of both opportunities to make money and also lose a lot of money. Factors responsible for the volatility synonymous with the stock market is as a result of factors such as interest rates, economic growth, stability, confidence and expectations, the bandwagon effect, related markets, and price-to-earnings ratio. Each of these factors will be briefly discussed in order to give you further insight into how they affect the volatility of the stock market. The rate of interest, especially the low level of interest, is attractive to both firms and attract investors. Shares with a low interest rate are highly sought out because of the greater dividend they offer. People buy more shares, especially when bond yields fall. A high interest rate will produce a negative reaction. Investors will be discouraged from investing in shares when high interest rates are attached. When there is an increase in economic growth, more companies will experience a boost in their finances. This will encourage them to also make shares available at moderate prices. A decline in economic growth will affect the stock market adversely. If you already own shares of a company, such decline will affect the valuation of the shares, which in turn will lead to a loss in investment if you choose to sell your shares. Instabilities that result from political crisis, terrorist attacks, and a drastic increase in the price of oil also affect the stock market. It makes the price of stocks fall in an unprecedented manner. The stock market thrives when the necessary stability is in place. Confidence and expectations have to do with the mood of investors. Investors will be willing to invest in stocks when they are confident that they will have a good return for their investment. On the other side, if investors feel that stocks will fall, especially if they have hinted at an impending disruptive event, they will be unwilling to risk their hard-earned money on such a venture that has a high possibility of making them lose money rather than gain money. This is an important factor that affects the stock market. However, there is an even more important factor, which is the bandwagon effect. Great investors like Benjamin Graham and Warren Buffett have observed that there is an overreaction that is often witnessed in the stock market. Graham explained this as the psychology of the market. Sometimes stocks fall just because people are scared that something terrible is about to happen that will result in the loss of money. During such moments, people start selling their stocks at ridiculously low prices. They do this in order to recuperate a little part of their investment. A good example of this was in 1987 when stocks fell by a massive 25%. Without a doubt, there is a lot of emotion involved in the stock market. It takes an investor who is able to see beyond these emotions to take advantage of the stock market. This is exactly where the technique of value investing comes in handy. As a value investor, you make the volatility of the markets your advantage. Value investor immunization. There are various approaches to stock marketing. However, value investing is considered the best approach of them all. The value investing approach to the stock market that has been made popular by Benjamin Graham and Warren Buffett is an important strategy. This approach immunes you from the volatility that is a common feature of the stock market. The volatility of the stock market makes people sometimes undervalue a stock. A value investor lives for such moments. Below are the advantages of the value investing approach to the stock market. A strategy for all. Contrary to popular belief, this strategy is not only for the rich. Some people feel that value investing is only meant for the rich who have enough reserve fund to take advantage of stocks with higher intrinsic value. This is not true. The key thing about value investing is not how much money you have, but how willing you are to work hard and exercise patience. Intelligence is what you need to succeed as a value investor. You don't have to be well educated before you can succeed as a value investor. Patience, in particular, is a key asset a value investor must possess. You are waiting for the time that people make irrational decisions because they are afraid stocks may fall. Fluctuations in the stock market are usually temporal. With patience, as a value investor, you capitalize on these short-term fluctuations in order to have long-term profit when the market returns to its sanity. Hence, it is not required that you have a deep pocket or a very good educational background before you can succeed in value investing. A clear mind that does not become quickly influenced when there is an uproar due to a purported decline in prices of stocks is also important in value investing. In order to be a successful value investor, you have to be less emotional and more logical. Being emotional is the reason for the volatility of the stock market in the first place. Hence, you have to be able to hold your ground and dispel the emotions of the market to succeed. Low risk, high rewards. This is the most important advantage of going for this approach. Every businessman or woman wants to maximize profit. I believe you are not different. Value investing ensures that you intelligently analyze the market and go for low-risk purchases, which have the potential to yield great returns in the future. Your biggest weapon as a value investor is being able to identify stocks that are undervalued. As mentioned earlier, the reason people undervalue stocks is often because of an irrational fear of an impending decline in stocks. During these periods, people become hasty to sell their stocks in order to minimize loss. However, as a value investor, you are able to critically and objectively evaluate the market to identify undervalued stocks. Hence, this approach ensures that you minimize loss and maximize profit. This is one of the most important factors that makes value investing the preferred approach to the stock market. Financial smart. Any investor who has the goal to succeed in business must be financially smart. Being financially smart involves so many elements. It involves being patient while others are hasty. This is important if you are going to make correct decisions consistently as an investor. Patience is, however, not good enough before you are regarded as someone who is financially smart. You must also be able to identify an opportunity when you see one. This ability is what has defined great investors. They can see what others cannot see. Identifying a good opportunity is also not enough. You must also be able to know when to pounce on the opportunities that come your way. If you identify a good opportunity, but you are not able to jump on it, you are nothing more than a speculator and not an investor. Ultimately, being financially smart is all about making the right decisions. As a value investor, you will be smart and skillful in the art of making financial decisions. Security analysis requires a decent level of intelligence. As a value investor, you will be required to carry out security analysis consistently. This enhances your ability to reason logically and arrive at an objective conclusion. The more experienced you are in carrying this out, the more financially smart you will become. Indifference to market fluctuations. The day-to-day fluctuation that characterizes the stock market does not bother a value investor. These fluctuations, however, cause other people to make wrong decisions. As a value investor, you already expect these fluctuations and use them to your advantage rather than fret and make irrational decisions you will regret later. Not being anxious is also good for your health. If you are constantly anxious, it will increase your blood pressure, and that will not be good for your portfolio. Lower tax rate. Another advantage of value investing is that it offers you the opportunity to make a profit with a low tax rate. This is because your investment is on a long-term basis. Hence, there will be less tax that has to be paid due to the long-haul format of this approach to the stock market. This reduction in the rate of tax is very important to your earnings as an investor. This makes value investing the best approach to stock marketing. Save more. Apart from the obvious advantage of helping you earn more, value investing also ensures that you save more. This is because fees that will have been charged to your account as a result of a commission from transactions will be avoided. This technique requires that your transaction is rare due to its long-term structure of the investment. Hence, you will be able to save fees that will have gone as commissions for such transactions. Compounding advantages. Compounding is an important tool that enables you to maximize profit. Value investing ensures that you are able to fully take advantage of this. The reason for this is not far-fetched. As you reinvest your profit from your initial investment, your money continues to grow with minimal effort. Great investors have been able to master the art of making their money work for them. This is exactly what value investing offers you. Some people feel that the returns are too minimal for reinvestment. However, the thing about money is time. Once you have your money increasing over time, what looked like an insignificant amount of money initially will eventually become worthwhile. Fun way to invest. Investing is often considered to be a difficult thing. It can be if you don't go about it with the right approach. An approach to investing that involves a value investing approach ensures that investing becomes fun for you. Sometimes it is almost as though you are just playing a game. The fact that you are in control and deciding where your money goes is amazing. You buy for far less and you sell to earn much more. You are calm before you make calculative risks. You are almost impeccable and have little likelihood of making any significant financial blunder. New investors will have to look up to you to discover the secrets of your financial success. Alas, they will find out that you are only an investor who is using a smart approach to make smart financial decisions. Chapter 8. Risk Management. When you hear the word risk, what comes to mind? For most people, it makes them nervous and fret. This is because they can only interpret the word in a negative way. You need not see it that way because risk is a part of life. As an investor, risk is a word you will come across frequently. This is because you have to understand how to manage it well in order to succeed as an investor. Risk management is of vital significance to both individuals and organizations. The ability to manage risk is a very important part of value investing. As a value investor, you must be able to identify deals that come with low risk and have the potential to bring huge returns. Hence, as a value investor, your risk management skills must be top-notch. Businesses and individuals must distinguish, assess, oversee, and report numerous types of risk for improvement outside of the choice-making. Risk is a word that has different implications for different individuals. It is a word that causes the sentiment of earnestness, since it tends to, at least once in a while, bring about calamitous results. This misconception significantly results from the absence of understanding about the importance of the word itself. Individuals utilize a similar word to address distinctive terms. In the event that you ask 10 unique people what they think of the word risk, you will presumably get 10 unique answers. Interestingly, risk is a critical idea in various logical fields, yet there is no agreement on how it is to be characterized and translated. Indeed, even among risk specialists in different professional bodies, there is a progressing banter about the topic at the core of their control. What's more, obviously, there is a gigantic variety of the term in general writing. Since the significance of risk changes with various circumstances and the human impression of it, a reasonable meaning of the word risk must be made. How might we talk about something that we have not even characterized? We continue to give a review of the key meanings of risk in account and value investment. What is the risk? The word risk may start from the Arabic word risk or the Latin word risicum. Notwithstanding contrasts of detail in characterizing risk, all definitions concur that risk has two attributes. It is identified with vulnerability and it has results. Risk isn't equivalent to vulnerability, regardless of aleatoric inconsistency or epistemic equivocalness. The relation between vulnerability and risk emerges from the thought of the outcomes. Maybe the easiest way to understand risk is the vulnerability that ensues, since vulnerability without outcome represents no risk. In 1966, the Commission on Insurance Terminology of the American Risk and Insurance Association affirmed the accompanying meaning of risk as vulnerability with regards to the result of an occasion when at least two conceivable outcomes exist. A risk can either be a danger, negative outcome, or a chance, positive. This meaning of risk resounds in the financial world, as most businesses or organizations that are either profit or nonprofit situated a need to manage risk so as to achieve their vision and objectives. Types of risk. Risk and value management are interrelated errands that ought to be parallel. In any case, value management practices are completed first to decide precisely what establishes value to the customer. The favored choice or choices are recognized, together with the potential risks that can occur. The value investor, or group accountable for the venture, rehashes the parallel activities of characterizing value and related risks until they land at the ideal parity of value and risk. These procedures then proceed iteratively for the duration of the life of the undertaking. In investment, there are a few risks that ought to be checked so as to enable the financial specialist to complete a consistent venture that will return profits. We are absolved with value contributing, alluding to the buying or selling of stocks based on an apparent hole between their present market cost and their value. When putting resources into stocks, bonds, or any venture instrument, there is much more risk involved than you'd suspect. How about we investigate the two essential types of risk? Systematic risk. Despite the fact that you may take out non-systematic risk, there is another risk which can't be eradicated. This sort of risk is the risk related to a specific kind of venture. For example, in the event that you put resources into the securities exchange, you will be liable to the risk related to stocks. In the event that you put resources into bonds, you will be liable to the risk of rising interest rates. All in all, systematic risk can't be disposed of, yet it tends to be appropriately overseen. There are numerous kinds of risk in this class. The accompanying table contains every last one of these risks and gives a concise portrayal of each. Unsystematic risk. The unsystematic risk applies to an individual organization. Unsystematic risk is the volatility of profits because of elements explicit to a given firm. The wellspring of volatility is owing to conditions special to a firm and may incorporate things like work strikes, generation issues, lawsuits, loss of contracts, management changes, poor management decisions, and more. These conditions influence the firm being referred to and, for the most part, not the whole market. For instance, in the event that you purchase ABC Basic stock, you expect the risk related with that particular organization as the risk of the industry in which the organization dwells. The risk related to the organization includes decisions made by management and the financial structure of the organization. Business risk. Business risk is the fluctuation of the financial specialist's working income. The working income, otherwise called the earnings before interest and duties, EBIT, is equivalent to the income less working expense. Anything that influences income, for example, changes in selling costs and deals with volume and working costs. For example, changes in expense of merchandise sold, selling costs, and organization's costs influence working income. The working income of certain ventures, for example, utilities and retail sustenance, are generally steady, while working earnings of different enterprises, for example, innovation and vehicles, will, in general, be increasingly unstable. The bigger the variances in working income, the higher the business risk. Financial risk. Financial risk is the extra fluctuation of an investor's overall gain because of the utilization of debt financing. The real wellsprings of financing of investors are close to home funds, equity, and debt. A few companies utilize equity, while others utilize a blend of equity and debt. The risk made by the utilization of debt is that debt requires the firm to pay interest charges, which is a fixed expense to the firm. The interest on debt must be paid, showing little attention to whether or not the firm is making a working profit or a misfortune. The greater the interest costs, the less the total compensation accessible to the shareholders. In this way, utilization of debt financing causes volatility of net gain far beyond the volatility brought about by business risk. Liquidity risk. Liquidity risk is the likelihood of not having the capacity to sell a benefit for equitable value. Liquidity is an essential trademark to investors in financial instruments. An investment is viewed as fluid on the off chance that it very well may be sold rapidly without a noteworthy loss of value. Illiquid investments uncover the financial specialist the risk that the investor most likely won't exit from, or the financial specialist may need to sell at a value much lower than the current market cost. Resources that are not worth the time exchanged convey a higher level of liquidity risk. Plenty of small companies are often inclined to liquidity risk than supplies of substantial and understood companies. Market risk. Market risk is the risk of a decline in value of an investment as a result of economic improvements or different occasions that influence the whole market. The primary kinds of market risk are interest rate risk, equity risk, and currency risk. Equity risk. This risk is related to investment in shares and stock prices. The price of various stock trading in the stock market fluctuates from time to time, depending on the factors of demand and supply. Thus, this risk is the adverse fluctuation of stock prices affecting the portfolio of an investor. Interest rate risk. This applies to debt instruments such as bonds, whether corporate or government bonds. Because these kinds of securities are heavily reliant on interest rates, a change in such interest is the key factor here. Hence, the value of these kinds of security is usually tied to the amount of interest rates that it can get in the open market. Currency risk. This risk is associated with international investors. For example, investors who hold securities of other countries. Thus, it is the implementation of the risk by a change in the value of the currency of the country of investment against the investor's country of residence. Inflation risk. Inflation deals with the purchasing power of money. Hence, this involves the risk associated with the change in the actual value of money. There is always a disparity between the price on paper and what the money can actually buy. Thus, countries that have experiences of high inflation rates usually have currencies with a high amount but with a low purchasing power. This phenomenon is usually prominent in the debt market. This is because this market is highly dependent on interest rates. These rates can be easily eroded by inflationary pressures. For instance, when a bond carries an interest rate of 10%, but the inflation rate is expected to rise above 10% in the same year, such an investment will be worthless upon maturity. Higher risk and higher return concept. A key thought in the account is the connection between risk and return. The idea that your earnings are directly proportional to the risk involved is quite common among investors. It is often believed that the higher the risk involved, the higher the chances of getting a big return. This is, however, not necessarily true. The technique of value investing mitigates this idea. The risk-return idea is the parity a financial specialist must settle on between the craving for the most minimal conceivable risk for the highest conceivable return. The higher risk and higher return concept posit that low dimensions of uncertainty, generally safe, are related to low potential returns, while high dimensions of uncertainty, high risk, are related to high potential returns. Choosing what measure of risk you can take on is a vital decision you need to take as an investor. It also posits that the more prominent the risk, the more noteworthy the normal return. The capacity and ability to go out on a limb fluctuates among investors, and investors will pick investments based on predictability with their risk inclinations. Investors who don't care to put resources into risky assets will consider the sans risk assets like treasury bills. A few investors like to put their money totally in the financial exchange, while others may put resources into a blend of the sans risk resource and the market portfolio. The definite arrangement of the financial specialist relies on the investor's risk inclination. Investors will decide doable venture choices dependent on their individual risk frame of mind and risk appetite. This will make them either risk-averse, risk-moderate, or risk-sweethearts. Contingent on elements like your age, income, and investment objectives, you might be happy to go out on a limb in your investments, or you may want to keep things a little more secure. It's critical that a financial specialist chooses how much risk to take on while remaining stable with his or her investments. Features of the higher returns, higher risk model. This model has some distinctive features that make it different from others. Some of them are discussed below. High risk and high returns. This feature should analyze the proportion of risk that applies to all assets and is not resource explicit. It should unmistakably portray what risks are remunerated and which ones are not, and give a method of reasoning to the outline. The model should examine institutionalized risk measures. For example, the model ought to decipher the proportion of risk into a rate of return. Considers both past and present. The model should function admirably at clarifying past returns and also foresee future anticipated returns. It's urgent to remember that higher risk does not rise to more prominent return. The risk-return trade-off just demonstrates that higher risk levels are related to the possibility of higher returns. However, nothing is ever ensured. Higher risk likewise implies higher potential losses on an investment. Risk management. Managing risk successfully requires proprietorship, senior management responsibility, comprehension of the procedure, and a functioning risk management routine surveyed normally in a productive, no-fault culture. The frame of mind on risk significantly affects the accomplishment of any venture. Setting a goal of not coming up short will not yield the expected results. On the other hand, a goal of succeeding will urge investors to be increasingly imaginative and to endeavor to screen and deal with the perceived risks. The management of risk is definitely not a linear procedure. Rather, it is the adjusting of various interlaced components which communicate with one another and which must be equal if risk management is to be viable. Besides, explicit risks can't be tended to in disengagement from one another. The management of one risk may have sway on another, or management activities which are successful in controlling more than one risk at the same time might be reachable. The entire model for managing risk can only work in an environment where risk has been properly categorized. The different kinds of risk explained above must be in focus for a value investor. He must be aware of the risk his business currently faces and how his portfolio will be affected. He must understand that risk is unavoidable. Consequently, he should know when risk is healthy and when it can be detrimental to his portfolio. This analysis must be holistic to produce a balanced portfolio. Investors' approach to oversee risk in a portfolio. Diversification. This is the least complex and best approach to decrease risk in a portfolio to possess a wide variety of investments. In this situation, the familiar maxim, "don't put all your investments tied up in one place," holds true. Apple Incorporated stock rose up 2,700% over the previous decade. However, because of terrible planning and absence of diversification, investment counsel Andy Zaki lost a huge amount of money in light of his risky choices. Consider the potential advantages of choosing investments from more than one resource class. When stocks have continuously evolving conditions, bonds may not be influenced as significantly. Avoid companies with debt. Amid times of economic thriving, stocks that convey vast debt burdens can turn out to be fine and dandy. However, when times get hard, loan specialists regularly get tight with money. When the credit market solidified amid the financial emergency, gaming companies endured. Numerous companies were compelled to relinquish ventures and additionally pitch properties to remain dissolvable. While Standard & Poor, S&P 500, has more than recuperated its losses amid the retreat, shares of Las Vegas Sands Corporation and MGM Resorts International are still well underneath pre-emergency levels. Each investment has a specific measure of risk. However, by breaking down the risk-remunerate equalization and substance of your portfolio, a significant part of the risk can be disposed of. Investing in blue chips. It sounds sufficiently straightforward. In the event that you need your portfolio to be steady and dependable, fill it with steady, solid companies. As opposed to investing in companies that you believe have the potential to be the next big thing, search for companies that have a demonstrated reputation of achievement. Instead of buying stocks with tremendous development potential for the future, search for stocks that have a background marked by solid development already. A considerable number of these stocks additionally pay out strong profits that give a consistent amount of returns amid market downturns. Avoid leverage and margin. As enticing as it may seem, exchanging on edge opens investors to pointless risk. By leveraging investments, it's not simply potential pickup that increases. One way that numerous investors add an excessive amount of leverage to their portfolio is by unreliably trading options. While choices exchanging can be worthwhile when benefited well, a key to any great alternative exchanging strategy is monitoring risk. Chapter 9. Habits of Great Investors. Investors have mastered the art of consistently recording success in business. They have been able to carve a niche for themselves at the upper echelon of the business world. They are great examples of the typical successful businessman and woman. They are pace setters in the world of business. Every aspiring businessman and woman wants to be a great investor as a result of the admirable traits they have, which has made it possible for them to achieve great success in business. This chapter extensively discusses the traits and habits that are found among great investors. The essence of this is not to admire them and praise them. The essence of this is to help you observe the traits that have made them successful in order to help you on your journey to being a successful businessman or woman. Below are the habits of great investors that have made them who they are today. They are researchers. Our world today has made it possible for us to have access to all the vital information we need to succeed in every sphere of life. Great investors have an unmissable knack for taking advantage of the information they have around them. They go as far as possible to ensure that they have all the necessary information they need in order to succeed in any business they have chosen to invest in. The truth is, if you are not informed, you will be incapacitated to make the right decisions in any sphere of life. Great investors understand that it is not good enough to inform. They reckon with the fact that it is imperative to be well informed also. They have realized that no one can act beyond the level of information they have access to. As a result of this, great investors are not just researchers, they are great researchers. They take their time to carefully examine the pros and cons of business before they venture into it. They study the pattern of the business and every possible loophole it has. They study the limitations of a business as well as the possibility of its long-term stability. Hence, whenever they venture into a business, they already possess the necessary information they need to succeed in that business. This implies that, in order for you to be a great investor, you must be an ardent student. You must enjoy spending quality time studying about any business. The fact that you have made the decision to read a book like this shows that you are on the right path already. Such disposition and habit to study will be needed to help you succeed in business just like the great investors you are aiming to be like. They have in-depth knowledge of the business. The end product of being a researcher is to acquire the necessary information needed to project you into the realm of success you desire in the world of business. There are only stiff competitions among the lowly. There are a lot of spaces to be occupied at the upper echelon of the business world. Only great investors occupy these positions. There are, however, many spots still up for grabs. The question is, are you ready to pay the price? It is not good enough to know what to do. It is more important to be willing to do what ought to be done. Being a great researcher is an attitude that drives great investors to spend quality time to study. However, the product of that attitude, drive, and commitment is the in-depth knowledge of the business that great researchers have. In business, you will be faced with a situation of making decisions, going for a particular option among the many you are exposed to. Anybody can make decisions in the business world and in life. However, it takes those who have vast knowledge about something to make sound decisions. When it comes to business, you will have to make decisions that will make or break your business. The issue is not just that you will have to make these decisions, it is that you will always have to regularly make decisions about your business. Hence, you cannot afford to be a novice in any business you have chosen to invest in. Great investors understand this. As a result of that, they are willing to invest time, energy, and resources in order to acquire the necessary information they need in order to succeed in the business they have chosen to invest their money in. Your ability to make quality decisions is a reflection of your level of wisdom. You have to be wise in order to succeed in business, just like the great investors you admire. Wisdom does not just fall down on people. Only those who are willing to pay the price by going all out for the right knowledge to possess this rare ability and to consistently make wise decisions will achieve this level of wisdom. They don't put their eggs in one basket. Great investors are not specialists. They know little about everything. They are always on the lookout for another business they can invest in, apart from the ones they have invested in already. No matter how well they are doing in a particular business, they understand that nothing is set in stone, especially in business. They have successfully mastered the art of having multiple sources of income. As much as they are patient before putting their money in any viable investment vehicle or business, they are always looking out for other options they can also take advantage of. Great investors are known for having multiple industries they invest in. The advantage of this is not just that it gives them the opportunity to widen their horizon and get income from multiple sources, it is actually a form of insurance policy they have. In other words, in case a particular business they have invested into is no longer thriving, they have other options they can fall back on and build on again. The business world is a world full of uncertainty. Hence, a prediction is not very easy. Several businesses that were thriving once had met their match. During such events, those who have invested a huge amount of money in those businesses often suffer a great loss. The aftermath of such occurrences often take a toll on people in very unpleasant manners. Some people lose hope in life during those moments and end up not knowing how to start over. Hence, great investors don't put their eggs in one basket in order to avoid such unpredictable events. They are not short-sighted. Great investors are visionary. They often have a 10-year plan for a business they are involved in. As much as the business world is full of unpredictable events, great investors understand that it is impossible to thrive in the business world when you don't have a plan. They are not just into business in order to make some quick cash. They want to build business brands that have a solid footing. They have the knack for building businesses that have long-term sustainability. Hence, they are not looking for shortcuts or quick fixes. They plan thoroughly before they get started. Hence, they have a good idea of the phases of the business. They know the full potential of the business and can predict to a very good extent how well the business will do in the next 5 years after establishment. This gives them two powerful weapons needed to thrive in the business world: insight and foresight. Great investors are not bullied or pressured to sell off their business to a bigger firm. They know what is obtainable from the business and will follow through to oversee the business. They are committed and passionate about what they do. Hence, they ensure that they leave no stone unturned in order to make it a success. They see every mistake as an opportunity to learn from. It's human nature to make mistakes. No one is infallible. Great investors don't see themselves as impeccable too. They know that in spite of their thorough planning, it is not impossible for them to call the wrong shot sometimes. However, they ensure that such occurrences are not the norm, just an exception to the rule. Mistakes from great investors are rare, but whenever they do occur, they see them as an opportunity to learn from. They don't criticize themselves such that they give up on themselves whenever they make a mistake. Instead, they see it as a learning curve. In fact, the mistakes of great investors in the past is an important factor that gives them the expertise they have at the moment. Their mistakes have given them the valuable experience needed to make the right choices in the future. Hence, whenever they are advising new investors, their mistakes are valuable tools for them. They know what will work and what won't work because they have experienced it all before. This makes it somewhat easier for them to always start again whenever they fail. They don't see a mistake as a defining moment for their careers as businessmen and women. They are wiser because of their previous failures. They always look forward to another opportunity to start over. They don't give up easily. Great investors don't see impossibilities. They enjoy challenges. They thrive in doing what others believe is not possible. They have confidence in their own ability to be successful. Hence, they are not interested in the opinion of critics. This does not mean that they don't listen to what others have to say. They just don't listen to critics who do not offer constructive criticism. This often makes people perceive them as arrogant. However, in reality, they are not arrogant. They are determined. Great investors don't know how to give up on themselves or their business. Whenever things are not working out in their favor, rather than give up, they believe that it is because there is something they are not doing right. This is also the reason why great investors are great researchers. They are convinced that there is a solution that they need to uncover in order to succeed. Hence, they don't give up easily. They have the knack for getting back up no matter how many times they fall down. They are never fazed, even when presented with the fact that there have been other people in the past who were never able to succeed because of the same challenges. They believe they can succeed in places others have failed in before. They consider themselves as trailblazers who will show others the way to succeed in a new territory. Their success story is often inspiring. This is because of an attribute that has seen them through as an uncanny semblance: resilience. Whenever you are faced with challenges in your business and you feel like giving up, you will realize that even great investors, those you look up to, have gone through similar or even worse challenges in the past, and they overcame them. There is never a champion without challenges. Conquerors are what they are because of the difficulties they have been able to overcome. Great investors understand this. Hence, they always get back on their feet whenever they fall down. They are concerned about stability. Great investors don't despise little beginnings. They prefer slow and steady to fast and furious. They want to achieve success, but they are concerned about the way they achieve it. They don't want to arrive at their destination with scars and bruises. This is also an important factor that makes great investors avoid shortcuts and quick fixes. They know that shortcuts and quick fixes will only lead to business structures that cannot stand the test of time. Great investors, therefore, put in the necessary effort needed for the business to thrive in place. Sometimes they do this by investing in people working with them, by helping them upgrade their skills. This further boosts the productivity of the business and its survival in the long haul. They build their business in such a way that the business becomes self-sufficient without their significant input. This also explains why great investors often take their time before investing in a business. They are not carried away by the current trend. They don't do business simply because there is a mad rush for that business. They want to build something that they can be proud of in the long run. Hence, they lay very strong foundations and carefully build on it. They often have an identity and core values they build their business on. Hence, whenever they receive suggestions that go against these core values, they are apt to reject it. They know what they want to do, and they have a defined way to get it done. They are not resistant to innovations, but only innovations that fit the core values they intend building their business upon. They don't mind the time it will take them to build their business. That is why their businesses are household names in the long run. They are not afraid to take calculated risks. Great investors are not rash, but they are never afraid to make difficult decisions. They are not hesitant in making decisions simply because they are afraid of the outcome of their decisions. However, they weigh their options properly before venturing into a business because the business world is full of unpredictable events, and therefore risk cannot be avoided in the world of business. Anyone who does not want to take risks has already put in the final nail into his or her own coffin in the business world. The business world is not meant for people who are rash. In the same way, it is also not meant for people who are too afraid to call the big shots. Important people in the business world are faced with making important decisions daily. They are faced with making decisions in which an error in judgment can send the business crashing to the ground. However, great investors are not afraid to make important decisions. They know that these decisions can ruin their business, but they are also fully aware that these decisions also have the likelihood of taking their business to an unprecedented height. They have internal control. This basically refers to one's attribution. In other words, your internal center of control refers to whether you attribute your success or failure to internal or external factors. When you find a linkage between your success and failure to internal factors, then you have an internal system of control. When you attribute your success and failure to external factors, you have an external sense of control. Great investors look inward for validation of their successes and failures. They never attribute their success or failure to non-internal variables, such as luck or governmental decisions. There is often a switch, an inconsistency in the locus of control for some businessmen and women. They will give the accolade of their success to themselves, but attribute their failures to other factors, such as luck or decisions made by others. Such inconsistencies are not found with great investors. They put in a lot of effort in order to succeed. They don't believe in factors such as luck to help them out. They identify every potential pitfall in their business, and they solve them before such issues ever arise. Hence, they will appreciate the input of others, but they ascribe their success to their own grit and efforts. Whenever they fail, they also do the same. They don't blame others for their failures. They attribute their failures to themselves. Whenever great investors fail, they trace the things they did wrong that led to the failure. This is why they often learn from their errors, which makes them wiser subsequently. When you attribute your failure to others, you have not learned from your previous mistakes. This will make you prone to making them again in the future. They value people. The greatest asset great investors possess is not properties or money. It is people. Great investors have great respect for people that work with them as well as their target audience. They are not into business for the sole aim of maximizing profit. They are into business in order to satisfy people. Great investors are adept at identifying a need and meeting them. They have the core value to meet needs by supplying goods and services. They see their business as primarily an opportunity to serve people. Of course, as they serve people, they end up raking in the cash. The long-term sustainability model of business that is synonymous to great investors is based on this. They make decisions that will benefit their customers while making cool cash. They adopt business models that enable them to enrich the lives of people. Great investors have large hearts. They are committed to people. This commitment often drives to always be on the lookout for other ways they can improve the quality of their goods and services in order to serve their customers better. Their terms and policies are tailored toward that same direction. They would rather incur losses than hurt people. Hence, they are always researching because of this commitment to humanity. This makes them often stand out among their peers. Great investors are not born, they are made. There is no destiny that makes a person a great investor. You choose to become whoever you want to be in life. The easy way out is to be mediocre. However, why settle for less when you can have the world at your feet? Becoming a great investor is not a lofty dream only secluded for a certain group of people. You can also become a great investor as long as you are willing to pay the price. Set your priorities right and make your dreams come true. Conclusion. The right attitude is important in order for you to succeed in any of your endeavors in life. When you have the right attitude, you will do all you can to ensure that you succeed in anything you have chosen to do. I am confident that you are on your way to becoming a great investor. Do you know why? Because you have the right attitude. How do I know that you have the right attitude? Well, to say the least, taking out quality time to read this book shows that you have the right attitude. This attitude is needed to succeed as an investor. Great investors invest quality time into research and acquisition of the requisite knowledge in order to succeed. Keep up this attitude because it will be needed for you to cope effectively in life. Keep pushing yourself and keep learning all that you need to learn. Great investors do not only invest money, they also invest time and energy. It is important to note that acquisition of knowledge is good, but there is something better. It is in the implementation of the things that have been learned. I don't want to believe that you have only chosen to read this book because you felt bored. In that case, you would have been better off reading a romantic novel or a comic book. I am also confident that you are not reading this book because there is nothing better to do. You will have been better off seeing a movie or watching a TV show. I am confident that you are reading this book because you wanted to bolster your chance of success as an investor. Hence, it is important that you take note of everything you have learned from this book and implement it. At this point, you have learned every fundamental aspect about value investing. It is definitely a technique that gives you an edge in the stock market. Don't hesitate to take advantage of this approach to stock marketing. As you already know, great investors like Benjamin Graham and Warren Buffett have made use of this winning formula to succeed as investors. You need not suffer bitter experiences that result from needless experiments. Doing what works is being intelligent. You can simply learn from the experience of those who have gone ahead and succeeded in your chosen field. You are on the right path already. It will be a terrible idea to invest quality time in a book like this and forget all that you have learned. When you implement what you have learned about value investing, the success you will record in the stock market will amaze you. You will have no choice than to recommend this book to others. Time is ticking. Get started today with these revolutionary ideas. This has been Value Investing, a comprehensive beginner investor's guide to finding undervalued stocks, value investing strategy, and risk management. Written by Blaine Robertson, narrated by Dave Wright. Copyright 2019 by Blaine Robertson. Production copyright by Blaine Robertson.